Good morning. My name is Kevin Began. I'm the Deputy Commissioner of the Healthcare Access Bureau within the Massachusetts Division of Insurance. Today's information session is being taped. In accordance with the provisions of 211 CMR 66.08, sub 3, sub E, the Division of Insurance has scheduled a virtual public information session beginning today, June 16, 2026 at 9:15, so that the public may present comments and the merged market health insurance carriers can present summaries of their rate filings for calendar year 2027 and the reasons for the proposed rate changes. I'd like to start by having Commissioner Michael Caljo give a presentation at the beginning. Mike?
Thanks, Kevin. Apologies for my voice. I'm recovering from a little bit of an infection, so I'll try to struggle through this and then stop talking, which will be good news for all my staff. As Kevin mentioned, I'm Michael Caljo, the Massachusetts Insurance Commissioner, and I wanted to welcome you all to today's public information session for calendar year 2027 merge market rate filings. It's an opportunity for the public and all interested parties to learn more about the filings made by the health insurance companies in Massachusetts and to comment on them. For 2027, health insurers have proposed an average premium increase of 12.9% on a base level in the Massachusetts merge market, which is comprised of individuals and small business purchasers. Insurers are required to present information on why premiums are increasing and how they will address consumer affordability. With the assistance of our actuarial experts, the Division of Insurance will continue to evaluate these assumptions over the coming weeks, pursuant to Massachusetts law, with final decisions expected sometime in August. Today, the Division of Insurance, ably represented by Deputy Commissioner Kevin Began, will ask carriers questions related to specific projections within their filings, including, but not limited to, medical trends, the impacts of provider contract negotiations, other related costs, pharmacy trends, utilization and mix projections, as well as administrative charges. This summary information has also been posted on the division's website for greater transparency. So with that welcome, I will now turn it over to Deputy Commissioner Began for the proceedings today. Thank you, Kevin.
Thank you, Commissioner. As the Commissioner just noted, we do have information on the division website. I'll share for just a quick moment. Information displayed on that website does demonstrate what the carriers have filed within our market. On that website, it indicates for each of the companies, not only the company name, the annual weighted average base change that has been filed, as well as the renewing enrollees for 2027. As Commissioner indicated, the average weighted base change is roughly 12.9%, affecting 697,000 members that are the merged market. Each company presented rate tables, and the information for each of the companies is listed within the Division of Insurance, available for all parties to be able to look at and to examine and to actually comment on. The following insurance companies have submitted 2027 rates for coverage intended to be effective for individuals, eligible individuals, and eligible small groups beginning January 1st, 2027. Blue Cross and Blue Shield of Massachusetts, Boston Medical Center Health Plan doing business as WellSense, Fallon Community Health Plan, Harvard Pilgrim Healthcare, Health New England, Mass General Brigham Health Plan, Point 32, composed of both carriers making filings, Harvard Pilgrim Healthcare and Tufts Health Public Plans, and United Healthcare Insurance Company. During today's session, our intent is to listen to the carriers actually present the reasons for the rate changes that have been filed, and then for them to respond to questions that the division has on certain of the elements of the filing. We will listen to speakers who have self-identified their intent to actually speak today. Those speakers are going to go in order after we should take a short break following each of the carriers' presentations. And then following that, we'll listen to any comments submitted by interested parties. I know that the first speakers are those from Blue Cross and Blue Shield. I'm going to ask if they could actually come on camera and actually make a presentation regarding the Blue Cross and Blue Shield. I believe it's Sarah Stanton and also Sarah Wilcox, but if you don't mind, if you could just identify yourselves as you're speaking, and then you're more than ready to begin. Thank you, Sarah.
Great, thank you, Kevin. It's nice. It's nice to see you. Good morning. My name is Sarah Stanton, and I'm the Vice President of Government and Regulatory Affairs here at Blue Cross Blue Shield of Massachusetts. Thank you for the opportunity to address our proposed merge market insurance rates for 2027. I want to be direct about the state of our healthcare system right now and the specific challenges within the merge market. We are at an inflection point. We can all see that the current system is not working. Costs are just too high. The math is simply no longer working for Massachusetts families, for small businesses, or for the nonprofit health plans that serve them. We've heard from parents choosing between groceries and prescriptions, small businesses struggling to keep their doors open with costs ever increasing. No one should have to choose between feeding their family and getting care. We're working every day to take on the root causes of rising costs and make coverage more affordable because healthcare should be a source of security, not a source of stress. Over the last few years, Blue Cross Blue Shield of Massachusetts has experienced unsustainable financial losses within the merge market, totaling tens of millions of dollars. The 15.3% rate increase we have filed for 2027 is not a number we arrived at lightly. No health plan wants to send members this kind of rate increase. Premiums are forced to rise when the cost of care and medications go up. Our rates are actuarial sound, established in accordance with general accepted actuarial principles and applicable actuarial standards of practice. They are responsibly calculated using a rigorous, data-driven process to accurately reflect the projected costs of our members' healthcare needs. Since late 2024, we've seen unpredictable increases in almost every area of spending. Pharmacy and utilization of inpatient and outpatient care are all increasing. So is severity, how sick people are, where they're getting care, and how providers are billing for those services. These increases really defy historical trends. Over the past 2 years, significantly more than 90 cents of every premium dollar we collect goes directly out the door to pay for member care. Internally, we're working to stretch that remaining 10 cents or so. This year, that meant holding our administrative spending nearly flat and making the difficult decision to implement a voluntary separation program across our organization to further reduce our operating costs. However, Blue Cross cannot solve the affordability crisis in a vacuum. If we want to prevent double-digit rate increases from becoming the new norm in Massachusetts, we all need to work together. We continue to urge the state to give healthcare cost growth benchmark real teeth, implementing concrete penalties for entities that ignore it, and we should be having serious conversations about setting limits on the prices we pay for hospitals and pharmaceutical costs. As Massachusetts marks the 20th anniversary of Chapter 58, we are reminded of how important it was that everyone came together 2 decades ago to solve the monumental issue of healthcare access. We achieved this together by working in a spirit of shared responsibility. Today, our focus must shift with that same collaborative spirit to solving the affordability challenges of this moment. We are encouraged that the Haley-Driscoll administration shares our sense of urgency on this issue, and we acknowledge the ongoing work of the Healthcare Affordability Working Group convened by the governor, and we appreciate the opportunity to participate in these discussions. It is exactly this kind of multi-stakeholder approach that is necessary to forge meaningful, long-term solutions. Doing this work will not be easy, but it's never been more important. We are fully committed to doing our part, and we look forward to working aside our partners in government and across the healthcare industry to make healthcare truly affordable. Thank you for your time today. I am joined by my colleague, Sarah Wilcox, who is able and available to answer questions regarding our filing.
Thank you very much. We appreciate your comments and agree. There has to be many steps taken to actually look at this on a higher level. I do have a number of questions about the Blue Cross filing itself, and whether it's Sarah Wilcox or Sarah Stanton. I think we're just looking to understand how you actually put the filing together and some of the elements of the filing. We know that the Health Policy Commission has set a cost benchmark of 3.6%. In filing for the 2027 rates, your company filed a medical trend of 11.4 and a pharmacy trend of 15.9%. These numbers are obviously higher than the Massachusetts cost benchmark set by the Health Policy Commission. Can you explain why your company's trends are above the Health Policy Commission cost benchmark and why your company may agree to contracts with providers where reimbursement rates may increase above the benchmark level?
Hi, Deputy Commissioner Began. I'm Sarah Wilcox, Vice President of Pricing and Pharmacy Analytics at Blue Cross. I'm happy to answer your questions about our rate filing today.
Good to see you again.
You too. We share the division's concern about rising healthcare costs. Our premium rates directly impact individuals across the state as well as local small businesses. The 2027 merge market rates we filed reflect three major drivers of increasing costs. First, our members are seeking more care and more complex care. Second, we have observed changes in provider coding patterns that are driving higher costs. Finally, the rates charged to us by providers and drug manufacturers continue to climb. In our medical claims, we see a steady rise in the volume of services that our members are using. Specifically, we are tracking more outpatient surgeries, behavioral health visits, and medical pharmacy use. At the same time, providers are asking for significant increases to their reimbursement rates. We are fighting hard to keep provider rate increases at or below the state's 3.6% benchmark, routinely rejecting proposals that are 3 to 5 times that amount. But we also have to ensure that our members have a robust network so that they can get care when they need it. To balance affordability with access, we are expanding value-based programs that reward providers for better health outcomes rather than just more volume. We are also seeing changes in provider coding patterns that are driving costs upward without any changes in how care is delivered. For inpatient care, we are observing coding changes increase the severity level within a diagnosis-related group, or DRG, which is the standard payment bundle mechanism for most payers. We are also observing evidence indicating coding changes are causing migration from lower to higher cost DRGs. On the outpatient side, we have observed significant and sudden increases in the percentage of evaluation and management, or E&M, visits that are complex, both in the emergency department and office settings. A higher complexity E&M visit receives a higher payment. In our pharmacy claims, spending is growing rapidly as drug manufacturers continue to raise drug prices. We aggressively negotiate discounts through our pharmacy benefit manager, but those discounts simply cannot keep up with the underlying inflation. We also observe sustained shift in utilization of drugs from less expensive to more expensive and often novel drugs. We are taking decisive action to protect affordability for our members. We stopped covering GLP-1s for weight loss in the merge market in 2026. We are also partnering with other Blue Cross plans to pioneer new outcomes-based contracts for high-cost gene and cancer therapies. We will continue to advocate for both individual policyholders and the Massachusetts business community and lead the way in finding innovative solutions to manage these rising costs.
Thank you. I think you've answered part of the next question, but I'd love you to to elaborate. Within the rate filing, there's a medical utilization mixed trend rate of 7%. And I'd like to hear about the cost containment steps your company's taking to reduce unnecessary and inappropriate utilization. You've mentioned some of your looking at severity coding. You've mentioned some of the value-based benefit designs. Are there other cost containment efforts you can talk about that Blue Cross has taken in order to really address unnecessary and inappropriate utilization?
Of course. So when we project our utilization and severity trends, we look closely at actual historical data and patterns to understand what is driving our members' healthcare needs. The 7% utilization and severity trend used in this rate filing is consistent with the rapid growth we have been tracking in actual emerging claims. As previously noted, we are seeing sustained increases in outpatient surgeries, behavioral health visits, and medical pharmacy use, which we expect to continue. Data suggests we are in the early stages of providers utilizing coding technology to optimize their revenue, which increases the cost of care. Our projections are well supported by underlying data and reflect our actuarial expectation these patterns will continue. While we want to ensure our members always get the care they need, we also work hard to prevent unnecessary or inappropriate utilization. We do this through several key programs. First, our clinical team of doctors, nurses, and other health professionals review care requests. This ensures patients receive the right treatment at the most appropriate and cost-effective site of service. Second, we offer care and pharmacy management programs like prior authorization, step therapy, and wellness initiatives. These improve long-term health outcomes while keeping clinical and medical costs down. Finally, we have rigorous payment integrity programs that audit claims to ensure accurate billing and aggressively identify fraud, waste, and abuse. Detailed information on all of these initiatives is outlined in the rate filing materials we submitted to the Division of Insurance.
Thank you. There's one thing I hope you might be able to explain as part of your filing. There was an adjustment that was identified as a negative 3.5 adjustment due to canceled plans and a negative 1.6% adjustment for benefit cost sharing changes. Is there anything you can elaborate to explain what is part of this year's filing that may be different from last year's filing?
Sure. These adjustments represent changes we have made in our merged market product portfolio for 2027. As healthcare costs continue to escalate, it is important that we ensure we are offering the most affordable products as possible for individuals and small businesses. First, we adjusted some of the copays in our products in order to align better with the recent claim trends we have seen. The negative 1.6% adjustment you mentioned represents an overall reduction to our premium as a result of these copay adjustments. Second, we canceled some of our more expensive merged market PPO and EPO products in order to focus more on our more affordable managed care HMO products. As members who were in a PPO or EPO product move into our less expensive HMO products, they will see a much smaller rate increase or even a rate decrease. The impact of this shift in our portfolio offerings is a lower overall average rate increase worth the negative 4% you mentioned. While this kind of portfolio adjustment is significant, it allows us to deliver better valued products to individuals and employers across Massachusetts, even during times of very high claim trend.
Thank you. The last question I have is just about administrative costs. I think there was an element of the filing that identified that there is an administrative charge change of 0.5%. Is there anything you can elaborate on regarding what that might be?
Yeah. We have worked hard to keep growth in our administrative expenses to a minimum. We are very proud that we've only projected a very low 0.5% increase to the administrative expense component of our premium. We know that local businesses, employers, and families are feeling a lot of financial pressure right now. That is why we work so hard to keep our own internal overhead tightly controlled. Even with general inflation and medical costs climbing at much higher rates, we have managed to hold our administrative spending nearly flat. We always have to keep these costs low because we have the highest medical loss ratio requirement in the country at 88%. That means at least 88 cents of every premium dollar has to go directly to paying for our members' medical care and pharmacy needs. We are highly focused on ensuring that premium dollars go exactly where they belong, which is directly towards paying for the actual costs of care rather than our own administration. The administrative costs that we do have are critical to ensure that we cover essential regulatory, compliance, and technology updates to run our plans responsibly.
Thank you very much. I think you've answered the questions that I have for today. You and all the other plans are well aware that our actuaries are going through all the assumptions with your filings and are conducting it at the same time, but I appreciate your comments and everything we presented today. Is there anything that you'd like to say in final, just about the Blue Cross filing before we move on to the next company?
No, thank you.
Thank you for being here today. If we could move to the next company, which is Boston Medical Center Health Plan, doing business as WellSense. I know, Paul, I see you on behalf of WellSense. Is there anyone else who's joining you today?
We're joined by Bo Lee, our Chief Actuary, who'll walk through the questions with you, Deputy Commissioner.
I appreciate it. Why don't you identify yourself for the record, and then we'll start.
Sure. Thank you, Commissioner, Deputy Commissioner, and to the entire DOI team. My name is Paul Wingle, and I am the Chief Product and Sales Officer at WellSense, with responsibility for our Affordable Care Act markets. WellSense, the BMC health plan, is a legacy Medicaid managed care plan attached to the largest provider of safety net care and access programs in the region. WellSense first entered the commercial market almost 20 years ago to participate in the Health Connectors programs, and consistent with our system's mission and focus, subsidized coverage through the Health Connector represents nearly all of our merged market business. For 2027, we are seeking an 11.9% increase, which is below the average sought this year. WellSense has filed a medical cost trend that is below the average requested in the market. And in addition, the growth rate of the unit cost reflected in our network agreements is 3%, below the Health Policy Commission's benchmark. Trend is heavily influenced by utilization, however. We continue to see tremendous pressure on pharmacy costs for certain brand name drugs, even without GLP-1 coverage for weight loss indications. In response to reduced premium subsidies, we are also seeing member migration to non-silver or non-connector care options, where unit costs are greater under our contracts. Behavioral health costs continue to add pressure, driven in part by state CBHC requirements, and there is persistent risk and burden of new benefit mandates in this market. We at WellSense also continue to be somewhat disadvantaged in a risk adjustment program that does not fully account for the actuarial value of connector care plans and forces transfer payments from low-cost insurers to higher-cost insurers. Nearly 20% of WellSense's premium dollars will be transferred from us to high-premium broad network carriers with much less subsidized non-group business. That noted, if the relativities of the filed rates hold, WellSense expects to be the lowest cost option in all or nearly all of the geographies we serve. Then, because of our focus on lower income populations, the vast majority of our members will feel little, if any, impact from the rate change. We understand that every dollar matters to our members, who tend to be on tight family budgets. We will note, however, that based on subsidy and affordability schedules through the Health Connector, nearly 60% of our members will see an increase of $4 or less, and 87% will stay under $9 a month, assuming the remaining portion of the Connector Care pilot expansion continues. I know you want to get into more detail in some of the questions, so I'll just stop there. And again, thank you for this opportunity, and turn it over to Bo Lee as you go through the questions you raised for us. Thank you.
Thank you very much. And Bo, if you don't mind identifying yourself for the record. Bo?
Sorry. Yeah. Thank you, everyone. I'm Bo Lee, Chief Actuary of WellSense Health Plan.
Appreciate your being here today. The first question is similar to one I asked Blue Cross. We know the Massachusetts cost benchmark is 3.6%. We know that your trend may be on the lower side for the market, but it still is above the 3.6% level. Can you articulate just the reasons why BMC has a trend level above the benchmark, and also explain why your company may agree to contracts with providers where reimbursement rates increase above the Health Policy Commission benchmark?
Thank you. Yeah. WellSense filed a projected medical rate macro trend of 88% for 2027, which is below 9.7 average sorted by other carriers this year. So, but in there, our projected medical cost trend actually is 3.0%, which is below 3.6% benchmark. But our overall medical trend is driven more by increased utilization and a shift in mix of services. So some of the driver in there is we're talking about the behavioral health. We have experienced a annual trend of behavioral health services exceeding 20% in both 24 and 25, with per member per month cost of behavioral health services nearly doubling over the 3-year period from 2022 and 2025. And just echo on Blue Cross colleague and the mix of service, we continue to see utilization of higher cost services outpacing alternatives, such as high utilization of emergency room and urgent care service related to physician office visits. And we want to mention a little bit like even expand some of the state mandate benefit, increase the range of service that must be covered, broaden eligibility for those services, and increase cost to the plan through cost sharing limitations. So the cumulative effect of these mandates contribute to the upward pressure of our overall medical trend. So regarding the individual provider cost above benchmark, so WellSense is committed to providing members with affordable health care, and so we continuously engage in negotiation with our provider partner to maintain cost-effective network that meet our members' need. We reserve the option to discontinue arrangement with providers who cannot or will not help us maintaining our cost position, although sometimes network adequacy rules limit that option. And sometimes we have to give concessions to critical providers with significant leverage in highly concentrated regional market. And as WellSense are heavily concentrated on business in Medicaid, oftentimes providers require higher reimbursement rate for our ACA commercial line of business to offset that lower Medicaid payments. In the past couple of years, we are also required by the connected rules to recontract every provider network across all metal tiers. It's also leading to higher reimbursement rate for our non-subsidized population. So this trend has been elevated and by tightening it, the connected care is tightening eligibility for subsidized plans. So also shifting members into this product with higher reimbursement rate.
Could you continue to talk a little bit about pharmacy? Pharmacy obviously is a trend number that is substantially above the cost benchmark. I'd like to hear a little more about the difficulties staying within the benchmark level on the pharmacy level and how you actually work to try to lower the pharmacy rate of increase.
Yes, overall pharmacy cost has been higher percentage on our overall medical cost each year, and has been predominantly driven by cost trend and projections from our PBM and consultant supporting that sustained high pharmacy cost trend. Utilization continued to shift away from lower cost generics toward new and higher cost brand and specialty drugs for chronic and complex conditions where no comparable generics are available. Over recent years, we have been particularly seeing like high growth in high cost specialty drugs. You can name like Humira, Skyrizi, Stelara, and the brand drugs with expanding indicators such as Jardiance. So when we're doing PBM contract, we are structured around overall financial guarantees, including discount of benchmark pricing, dispensing fees, and manufacturer rebates. While this contract structure help ensure we are competitive get competitive overpricing, but they do not provide license with direct control over the price of individual drugs. And recently, we also see decline manufacturer rebate due to the ongoing adoption of biosimilars and shifting in pricing driven by federal regulations and adjustment related to the 340B programs. So to contain cost, we know that these pharmacy costs have been always outpacing medical counterpart. We are very aggressive engaged with our PBM to make sure we have regular market check and continuous negotiation with them. We also implement utilization management program to make sure our drug use on a member level are clinical appropriate. Our formulary promote the use of lower cost generic and biosimilars. So higher cost drugs are often managed through prior auth and step therapy programs. And we continue to monitor prescribing patterns and emerging trend to ensure the coverage of high cost drug is restricted to clinically appropriate use in order to mitigate cost pressures. We have newly implemented medical drug management program to make sure our the high cost therapies and outpatient drugs are appropriately used and clinical appropriately.
Appreciate that. Just to return to it, I think something you had mentioned earlier, obviously there's increased utilization of certain types of services, a more intense utilization of services within the rate filing, public rate filing. There's something referred to as an annualized medical utilization mix trend of 5.6%, which usually identifies an increase in the severity or the intensity of medical services. Can you elaborate a little more about what BMC is doing to actually address that so that there is only really necessary and appropriate utilization? You're doing things that are reducing unnecessary and inappropriate medical utilization.
Yeah, we same as other carriers, we are active managing these through care management programs and utilization management programs. So care management program will provide added support to members with ongoing serious health conditions, help them assess the right care and avoid unnecessary emergency visit or hospitalizations. Recently, WellSense also insourced behavioral health services to advance an integrated care model, coordinating medical and behavioral health treatment. This approach will improve early identification and management of behavioral health conditions to decrease avoidable high-intensity events by ensuring that members receiving the regular support that they need. And that will help curtail rapidly increasing the behavioral health cost in the space. And just like I just mentioned, we just implement medical drug management program, so ensure that high cost medication administered in the clinical settings are used safely and appropriately and in line with clinical guidelines. This program actually applies additional review and oversight to help ensure members receive effective treatment while managing the growing cost associated with specialty and injectable drugs. So WellSense remained committed to managing utilization responsibly by reducing unnecessary or inappropriate service while ensuring members have access to high quality clinical appropriate care when needed. So this effort involved a range of programs such as PA and the process of reviewing medical necessities.
Last question, Bo. I know that much of the focus of a rate filing is to look at the rates that go into effect. First, we are aware small groups do renew throughout different periods of the year, and that in looking at the filing, there is a different rate change for the first quarter compared to the second through fourth quarters, so that the base rate change is supposed to increase by 11.9%, but the base rate change for the second through fourth quarters Peralta proposed to increase by close to 17%. Anything you can elaborate on for that difference?
Yeah, thank you. So first, this whole year rate, they are all developed on the same consistent pool experience. So the rate change of each individual product is the same in all quarters of 2027. So the average base rate is weighted by project enrollment by effective quarter. For WellSense, over 99% of our projected calendar year 2027 membership, including all of our subsidized membership population, are expected to enroll in plans with an average base rate increase of 11.9 effectively in 1Q calendar year 2027. But the base rate change for second quarter to fourth quarter, they show a higher average increase since they only include the small group plans and do not include the subsidized plans, which are only offered in the individual market with rate effective 1Q 2027. So our subsidized population will see the lowest rate increase of 11.2%. This is helped by a 4% reduction of our silver loading requirement. So we know that subsidy has been changed, program changed. So the subsidized population, because of the Connected Care program change in 2026, we are seeing the population will need less silver loading requirement. So the first quarter subsidized population will benefit from that, but second quarter to fourth quarter, they are all small group plans, which is very small population. We are talking about a few hundred members in our more than 140,000 membership. Our subsidized population will further share from this increase. We are requiring 11.9% because of premium subsidies and also the Health Connector affordability schedule.
Thank you very much. That really exhausts the questions I have today. As you know, our actuaries are asking many questions and reviewing the rate filing. Is there anything you'd want to say in summation, or are we all set with BMC?
We're all set. Thank you very much.
Thank you for
coming today. Appreciate your participation. Next, we'll be talking to Fallon Community Health Plan, and I believe their chief actuary, Mr. Sal Ciccioli, will actually be on.
Salsiccioli.
Thank you. You know, John, I knew I'd mispronounce it. If you don't mind just introducing yourself to everyone, and then if you could begin.
Sure thing, Kevin. Good morning. I'm John Salsiccioli, the Vice President and Chief Actuary at Fallon Health. In my role, I oversee the actuarial work that supports our pricing, forecasting, and financial sustainability. I'm here today on behalf of Fallon Health, a mission-driven, not-for-profit community health plan. We serve nearly 150,000 members with a strong focus on government-sponsored programs, including Medicaid, Medicare, PACE, and the Massachusetts Health Connector. For nearly 50 years, our focus has been consistent, balancing affordability for our members with responsibility of keeping coverage available and sustainable. That approach allowed us to keep increases low in recent years. From 2024 through 2026, Fallon Health had the lowest average premium increases in the market. Our 2027 filing reflects a significant shift. We submitted a 25.7% rate increase, higher than our prior filings and higher than others this year. Today, I'll walk through what changed, what we've done in response, and how we're working to maintain affordable, sustainable coverage. Reviewing the drivers of our rate increase, this filing reflects several cost pressures that came together quickly. First, in 2025, our community care membership grew faster than expected. That growth was driven by post-public health emergency changes and shifts across the Medicaid and connector markets. At the same time, costs increased and our financial performance changed significantly. Our medical loss ratio rose to about 110%. In simple terms, for every dollar we received in premium, we were spending about $1.10 on care, and this is before factoring in our administrative costs. A major driver was risk adjustment. Historically, Fallon Health received payments through the risk adjustment program. However, in 2025, that flipped and we became a net payer. That shift alone had a significant impact. We also saw higher claims costs, increased use of high-cost medications like GLP-1s for weight loss, and changes in the members we're serving. Because 2025 is the base year for 2027 pricing, those higher costs flow directly into this filing. We did take action for 2026, increasing rates by 7.2% and ending coverage for weight loss drugs, but these actions were not enough to offset these pressures, and losses have continued. When we project forward into 2027, we're faced with a simple reality. Without a meaningful adjustment, the plan would continue operating at an unsustainable loss. At a high level, the increase reflects changes in risk adjustment, higher claims and more high-cost care, shifts in member health status, and continued pressure from utilization, drug costs, and fees. To put it simply, we have more members, more high-cost care, and a different risk profile, all happening at once. While these pressures are real, we've taken steps to limit their impact. First, we built the filing with restraint. Our overall trend is 6.9%, below the market average, with both our medical and pharmacy trends being the lowest across all plans. And our administrative costs are lower than others. We're also directing more of the premium dollar to care. Our MLR target for 2027 is 94.6%, the highest among plans. At the same time, we made difficult decisions to restore sustainability. These include focusing our geographic footprint in areas where we can operate sustainably, reducing our contribution to reserves, and limiting administrative cost growth, even as membership declines. These are not easy choices, but they matter. Without these actions, the required increase would have been even higher. There are limits, however, to what operational changes alone can solve. We've reduced margins, constrained cost, and narrowed our footprint, but those steps cannot fully absorb the underlying cost pressures. We've taken disciplined, mission-aligned steps to reduce the impact wherever possible, while still ensuring the plan remains viable. When considering how we compare to other plans in the market, it's important to look at this year's filing in a broader context. From 2024 through 2026, Fallon Health consistently delivered lower increases than the market at 1.2%, 1.3%, and 7.2%. For 2027, our filing is higher than others this year, and we recognize that. But when you look beneath the number, our trend assumptions are lower than market, our administrative costs are lower, our margin is lower, and our share of premium going to care is higher. While the total increase is higher this year, the way we built it reflects a measured and responsible approach. Over time, our pattern has been clear. Keep rates as low as possible for as long as possible. When looking at the market dynamics, it's clear that Fallon Health is not the only carrier feeling similar pressures. Across the market, plans are experiencing higher utilization, increased use of high-cost medications, changes in risk adjustment, and medical loss ratios above 100%. These are broad trends affecting the connector market and beyond. What's important is ensuring plans can continue to participate in a stable and sustainable way. When rates reflect underlying costs, plans can remain in the market, and members continue to have meaningful choice. Our approach has been to remain disciplined, lower trend assumptions, lower administrative costs, lower margin, and a higher share of premium going to care. These choices reflect our mission and our commitment to long-term stability. In closing, our goal with this filing is to strike the right balance. We want to keep coverage as affordable as possible while ensuring it remains sustainable for the members we serve. We believe this filing reflects that balance. It's grounded in actual experience, it's built with meaningful restraint, and it's designed to support long-term stability. And we appreciate the division's thoughtful review. Thank you.
Thank you, John. Appreciate your being here today. I think just as an opener, I want to make sure I understand one point, because I do understand that Fallon has put in a trend level that is on the lower side of the market. And just to help explain, if the trend for Fallon is at 7% roughly, can you fill in how the rate increase is at 25%? This is because you're increasing your base to actually reflect what actual costs are in the market that you paid. Is that correct?
That's correct.
So I think that's the one thing that we want to make sure is clear to all. It's not that your trend is at 25%. It's that it is instead a trend over your readjustment of the base to reflect you can't be at 110% MLR, correct?
It's starting with a year of 2025 at 110%, and that's our starting point. To restore sustainability, we are looking at a very significant rate increase, even with trends that are the lowest in market.
Appreciate it. Thought I should at least highlight that up front so that anyone who's looking at your trend numbers and looking at your rate increase understand there's a reason why for Fallon they're not actually the most important thing in the 25%. It's actually rebasing from the beginning. Still, at the same time, we have to ask about just even trend numbers being above the cost benchmark set by the HPC. 7.3 is what was in the filing, which is still above the 3.6%. Anything that you can elaborate on why your company may agree to any contracts in the market with any provider, why reimbursement rates may increase above the Health Policy Commission level?
Yep, thank you. So we approach provider contract renewals with the cost growth benchmark of 3.6% as the maximum available annual increase. However, in limited circumstances, providers that have overwhelming market leverage, we did provide increases modestly above the 3.6% benchmark. This market leverage can include things such as geographic need due to state access requirements, service exclusivity, provider market dominance, or brand reputation. We work with providers to find other levers to reach a contract agreement and only exceed the benchmark when the loss of that provider would cause material harm to our members, our ability to offer a competitive product, or our ability to comply with regulatory requirements.
Can you go through one of the features of your filing that talks about risk adjustment? It identifies a 5.1% impact. You highlighted some of the changing dynamics within your filing, not only that you had members grow at a level that you had not originally projected, but also the fact that you're changing which parts of the market you're concentrating on. How does that all factor into a 5.1% impact on the overall rate change?
This is largely due to the fact that in 2025, we did move from historically being a receiver of funds to being a payer into the pool for risk adjustment. Our filing for 2026 assumed that we would still continue to be a receiver of risk adjustment since that was based on 2024, where we were a receiver of risk adjustment funds. So while claims costs continue to rise, the amount of risk transfer dollars is not compensating Fallon accordingly. In other words, the increase in claims is not really being offset by an increase in risk adjustment. It's partly a function of the morbidity of the single risk pool deteriorating, which means higher premiums are necessary to cover the population.
So even with the steps that you're taking to actually change the service areas that you're in, you're still seeing this continues to mean that you're expecting risk adjustment to change going forward.
That's correct. Without those geographic changes, our risk adjustment would have been lower.
Anything you can comment about your benefit adjustments? There's a 2% benefit adjustment included in the filing. How does that actually work, and what is the benefit adjustment?
Yep. The 2% benefit adjustment really represents the change in pricing actuarial values from 26 to 27. It's really driven by two components. The first is benefit leveraging, and the second is expected changes in our membership distribution by metal level. For the former, as the overall morbidity of the population increases, the same plan benefits will cost more to cover due to members utilizing at a higher rate, a higher severity of services, and fewer non-utilizers, therefore increasing the actuarial value of the plan, all else being equal. And for the latter, we're expecting to have a larger proportion of bronze and unsubsidized silver members in 2027 relative to 2025. The impact of benefit leveraging is more significant at these metal levels.
Last question has to do with the quarterly changes. Again, we recognize that much of the focus is on the first quarter rate change. We look in the filing and there are slightly higher rate changes projected for the second through fourth quarters. Can you just elaborate on why Fallon's filing for different rates for those quarters, expecting small groups that will enroll in those quarters?
Sure. So rate increases for our product portfolio will vary by quarter due to quarterly premium adjustments that are permitted in the small group market. Issuers in the small group market can account for an incremental claims cost trend as groups renew in quarters 2 through 4. I'll also note that more than 99% of our membership is expected to renew in the first quarter and will receive the average rate change of 25.7.
So is there anything in conclusion that you'd want to identify for us to understand about the Fallon filing? Otherwise, you've answered all the questions I have at this time.
Nope, I think I'm all set, Kevin.
Thank you very much for being here today. Appreciate your time. We're going to ask that representatives from Health New England who join. I believe Mark Danberg-Wild, are you a part of this? And are there any other individuals joining you?
Hi, Kevin. Yes, Mark Danberg-Wild, Chief Actuary for Health New England. I believe I will be doing most of the speaking for Health New England today.
Thank you very much for coming. Please proceed.
Okay, thank you. So Health New England is a not-for-profit health plan owned by Bay State Health and focused predominantly on residents of Western Massachusetts. Our 2027 filing offers plans in our core area of Hampton, Hampshire, Franklin, and also Berkshire counties. We will be offering 35 plans in 2027. That includes 3 plan discontinuations and 3 new plans since last year's filings. Those discontinuations represent about 2% of our total membership, and those members will be mapped by default onto broadly similar plans of nearly equivalent actuarial value. For 2027, we are proposing an average rate increase of 11.1%. That's the largest driver of that is an increase in our unit costs for medical services and prescription drugs. The overall cost per service for medical services is expected to increase by 4.8%, while prescription drug costs are expected to increase by 8.2%. The increases in cost per service for medical service are driven by growing pressure from providers to reimburse at a higher rate, as well as an increasing mix in higher cost services, very similar to what you've been hearing from the other carriers in the market. So all the pressures in terms of supply chain shortages, overall inflation, workforce challenges, all of those continue to provide pressure for providers to seek higher reimbursement for their services. And Health New England is using a mix of different strategies to negotiate with providers so that we are trying to move from being so much on a fee-for-service basis to also to increasing our number of value-based arrangements with different provider groups. Those value-based arrangements hold physicians and hospitals responsible for managing their patients at certain quality and cost targets. And we are utilizing all data that we can get to help manage those contracts and try to move things in that direction. The pharmacy cost trends are quite high, but they are down since last year. And that reduction is due to a couple of factors. The removal of GLP-1 drugs for weight loss had a significant impact on our pharmacy trend. And further, we removed the spend on those drugs from our base experience before forecasting to 2027, which reduced our required increase by approximately 2% overall. That's for medical and pharmacy combined, not just for pharmacy. Our pharmacy team is also working vigorously to move members on high-cost pharmaceuticals, especially biologics, onto lower-cost alternatives that are becoming available and which have equivalent clinical outcomes. The other driver of Health New England's rate increase is the increase in utilization, which is expected to be up by about 4% for medical and 3.5% for pharmacy. Some of that is coming from facility claims, both inpatient and outpatient utilization trends being observed to be higher since last year, but more of the increase is coming from professional and ancillary claims. We recognize that that is a significant increase, but again, very similar to what you've been hearing from other carriers in the market. So we have a number of programs in place to help members manage their health and well-being, and are working closely with our parent company, Bay State Health, to find ways to continue to improve care while reducing costs. And that includes a number of care management programs that should help members with chronic health conditions to manage their health in a way that helps reduce utilization of higher cost programs and allow them to seek care in lower cost settings. So is sort of the quick overview of where we stand with our filing, and I'm ready for any questions that you may have.
No, I appreciate it. And some of these you've answered within your comments, but still like to elaborate a little more. I think that we see that your trends, 9.2% for medical and 11.9% for pharmacy, they include both the cost and also utilization changes, just concentrating on cost. Can you explain a little bit why Health New England finds they need to agree to reimbursement rates with providers that are above the health policy benchmark of 3.6%? I mean, this is one of the problems we are trying to understand within the market, how the benchmark is set, but it seems that companies are going above the benchmark level.
Yes. I mean, while our trends do exceed the Health Policy Commission benchmark, they are consistent with and lower than the overall market experience, given the industry averages of 9.7 for medical and 12.7 for pharmacy across all the carriers in this year's filings. That said, I mean, we do recognize the importance of the Commission's cost benchmark and continue to actively seek strategies to moderate trend. One example is we are currently working on contracting initiatives to reduce allowed costs for claims from our RAP network, which results in a projected approximately 0.7% reduction in medical costs that was used in our filing. But in some cases, H&E has had to agree to higher increases than the benchmark due to verified cost data from the providers that we are negotiating with. Typically, though, in such cases where we are agreeing to a higher increase, it is to maintain critical access where there are limited alternatives given the provider's ability to insist on larger increases than we would prefer, and there being the only available option within a particular specialty or geography.
I think on the utilization side, we'd like to hear your comments about why utilization and mix rate is increasing by 4.2%, and what Health New England is doing to actually establish cost containment that would lead to a reduction of unnecessary and inappropriate utilization. I think we've heard this from a number of carriers, but it's important to hear about what each plan is actually doing to try to reduce unnecessary and inappropriate utilization.
Sure. Our utilization projection is based on a detailed analysis of actual utilization trends for Health New England's commercial lines since 2023. Since last year's filing, we have seen a modest increase of approximately 0.5% in utilization for facility claims and pharmacy, but we're seeing much higher utilization in two specific categories, professional services and ancillary claims. In the professional utilization, that's actually something of a positive, as it indicates potentially greater access to primary care, which has potential future cost savings associated with providing that care in a lower cost setting. Ancillary claims, which uncovers things such as home health and prosthetics, is a low volume and lower cost category and not a significant driver of our overall utilization. But the increase in that particular category is driven by ambulance and miscellaneous other codes. So Health New England does have a number of programs in place to manage cost in different domains of medical care, in particular programs to help manage the cost and improve the member experience for chronic health conditions such as COPD, diabetes, depression, or hypertension, as well as programs to reduce risk associated with childbirth and premature infant care. We have processes in place to evaluate new programs for cost savings, in the form of claims edits, utilization management, new contracting efforts. Broadly speaking, we are attempting to adapt to the regulatory expectations around prior authorization and shifting towards approaches that maintain appropriate utilization oversight while reducing the administrative burdens for providers and members associated with that oversight.
Is there anything that you'd want to comment on pharmacy, how you were actually doing the same thing regarding reducing unnecessary and inappropriate utilization?
The one thing I would call out there is again associated with the removal of the GLP-1 drugs for weight loss. That has led to a certain degree of people seeking those drugs for other indications or seeking to get themselves diagnosed as diabetic or whatnot. We do have programs in place to excuse me, help those members attempt to do the weight management from a dietary approach as opposed to a pharmaceutical approach. And otherwise, I'm not immediately aware of additional programs associated with step therapies or things of that nature to specifically address the pharmaceutical. I know that we have such programs, but I cannot speak to any specific new ones for this year.
Appreciate that. Your filing also included a negative 0.8 benefit adjustment. Can you elaborate on what that is?
Absolutely, yeah. So I'll note that we did have some technical issues with filling out the data collection tool this year. And as some changes were identified during the review process we've gone through so far, our filing now includes a minus 0.4% benefit adjustment rather than a 0.8% benefit adjustment. I apologize for the confusion that has caused. That adjustment is driven by the federal requirements for plans to be rated at a given metal level. So each year, in order to meet the requirements of CMS's actuarial value calculator, we evaluate all of our plan designs for the current plans on the market. And usually there's a need to somewhat tweak designs in order to stay within the de minimis range for a given metal level. In this year's filing, we did have to change deductibles, out-of-pocket maxes, and copays on multiple plans, leading to the benefit adjustment impact. In some cases, even with no benefit changes made, technical changes in the AV calculator from last year to this year nonetheless made it show as a benefit adjustment. These are usually quite modest and do not materially change the overall value of the coverage that members are receiving. And our overall adjustment is similar to the adjustment seen in most other carriers' filings this year.
Thank you. I think there's also a 2.5% risk adjustment item was shown on our website for Health New England. Could you elaborate on that?
Yes, and again, due to some technical difficulties with the data collection tool, after making updates, our filing includes a 1% adjustment due to risk adjustment. So this 1% adjustment reflects an expected decline in risk adjustment receivables for Health New England. In both 2024 and 2025, or 2025 projected basis, Health New England is a net recipient of risk adjustment dollars. So that is to say, due to the relative morbidity of our population compared to the market as a whole, Health New England is receiving compensatory payments from other carriers in the market. Prior to 2024, Health New England was typically a net payer of risk adjustment dollars. However, in 24 and 25, the years in which Health New England has been a recipient, that has been due to a net receipt on membership on the individual market and a net payment on membership from the small group market. With the removal of the federal advanced payment tax credits in 2026, Health New England has seen our mix of membership change rather dramatically. Our individual side has shrunk by about 15% year over year. Because of that, we expect to receive correspondingly fewer dollars in 2027 for the individual market, but still have to pay a comparable amount in the small group market, leading to a net reduction in the amount of dollars we will receive for risk adjustment in the projection period.
Thank you again for your time today. You've answered the questions that I had prepared for today. I'm aware, and you are aware, that our actuaries continue to review your filing, and we'll have those actually conducted in the CERF environment. Is there anything you want to say in conclusion for Health New England?
No, just thank you to the reviewers and the DOI staff. It's been a good process so far, and look forward to continue working with you through the remainder of the process.
Thank you very much. I'm going to ask that representatives from Mass General Brigham Health Plan actually come on screen now. I believe that Sujata Sangvi is actually representing Mass General Brigham Health Plan. Is there anyone else that's joining you today?
No, it's just me, Kevin, today.
I appreciate it. Don't see you on screen yet. There you are. Very good.
Okay, great.
Please proceed.
Thanks. Hi, I'm Sujata Sangwi. I'm the Chief Actuary of Mass General Brigham Health Plan. I'm a fellow in the Society of Actuaries and a member of the American Academy of Actuaries. I want to first thank the division for arranging this forum and just the continued collaboration on the annual merge market rate process. And we also look forward to getting the input from and hearing the input from our customers, including the small business community and consumer advocates, as we work hard to support the members' healthcare needs and experiences in this challenging environment. Mass General Brigham Health Plan was founded 40 years ago this year with a local community focus. We today serve over 400,000 members across multiple service lines. In addition to the commercial business that we're discussing in merge market, we are committed to serve government lines of business, including Medicaid, Medicare Advantage, and beginning this year, participation in the dual eligible marketplace. With Mass General Brigham, an integrated healthcare system, we're advancing innovative solutions for multiple markets that center on the healthcare needs of our members and enable an exceptional healthcare experience. We serve about 80,000 members in the merge market with a range of plan options, and really have been growing in this market because we are providing value and choice for the Commonwealth's residents and small businesses. Our filed average base rate increase this year is 13.5%. We developed our rates starting with our 2025 base experience, as you know, projecting it forward for changes in cost and utilization, benefit and product changes, as well as a mix of membership. Our rate filing targets a medical loss ratio of 91.9%, meaning 92 cents for every dollar goes towards medical expenses, as opposed to other elements. That's 4% higher than the minimum threshold here in Massachusetts. And we're targeting this higher medical loss ratio, really reflecting our commitment to containing administrative expenses and maintaining affordability. Our proposed rate filing this year reflects significant market changes that are occurring due to regulatory changes, as well as the anticipated increases in cost and utilization of healthcare services. And it reflects an average trend of 10.5%. I'm going to talk a little bit more about the market factors. I think they've been discussed a little bit less today, and then also touch on trend. The market factors that are impacting our rate filing include regulatory changes and market conditions that are driving healthy members out of the merge market and leaving the overall risk pool sicker, which is raising premiums for everybody. The implementation of recent regulatory changes, including the end of enhanced premium tax credits and changes in eligibility for connector care subsidies related to the One Big Beautiful Bill Act, has made health insurance less affordable for many consumers. And this has resulted in many people losing coverage. On average, the folks leaving the merge market because of these shifts have lower health needs compared to the folks that remain in coverage. People who really, really need healthcare find a way to afford it. This raises the average risk in the market and within Mass General Brigham Health Plan's covered lives, and then results in higher claims costs and higher trends. In addition to these pressures in the individual market, the small group market is being fragmented by growth in enrollment in unregulated, level funded, or ASO products. This market has been growing exponentially and is now 11% of the overall small group market, up from 2% 5 years ago, with most of this growth coming through national carriers, many of whom don't participate in the merge market. Groups purchasing level funded products are considered self-insured and therefore are not subject to the regulation or guaranteed renewability provisions that apply to merged market plans. These products are medically underwritten. And what that means is the rates are dependent on understanding the medical conditions and expenses of an individual group. And that pulls, so they're lower if the group is known to be healthier and higher if a group is known to be sicker. That's not allowed in our regulated merge market. And the result of that is groups that have favorable risk get pulled out of the merge market risk pool, leading to a deterioration of what's left in our pool. We've seen a rising incidence of high cost claims. Last year, we had 17 claims over $1 million compared to 11 the previous year. But more importantly, of those claims, 5 of them were over $1.6 million compared to none over $1.6 million the previous year. Part of what this is illustrating is the adverse selection that we're seeing in this market, as well as the increased costs related to new therapies. We've talked a lot about industry-wide increases in cost and utilization, and we've heard a lot about that. We're experiencing very similar trends. Utilization and mixed trends are being driven by rising incidence of chronic conditions, as well as new medical technologies and treatments, which are improving outcomes, but often come at high costs set by manufacturers. We've worked really hard to limit provider unit cost increases through contractual negotiations. Despite these efforts, the combined impact of steward closures, reduced government reimbursement, and the lack of competition in certain geographic markets has resulted in unit cost increases, which are reflected in this filing. This filing also incorporates our efforts to improve the effectiveness and efficiency of and utilization management and care management processes through investment in greater integration between plan and providers, both from a technology perspective and a payment perspective. Pharmacy costs also continue to rise, driven by increases in specialty in particular, and the movement of GLP-1 drugs, for example, as a first-line treatment for diabetes and prediabetes. Mass General Brigham Health Plan is committed to providing high quality and affordable healthcare coverage centered on the needs of our members. We have a comprehensive approach to reduce the impact of these market forces while ensuring access to care for members where they need it and when they need it. We have a very active cross-functional work group that works to identify cost drivers and opportunities to mitigate any of these increases and review the efficiency of existing programs. Our rate filing builds in expected savings from these initiatives through 2028. Our integration with Mass General Brigham also provides a platform for collaboration and innovation in value-based care. Thank you for the opportunity to provide this summary. Be happy to take questions.
Thank you very much for your time, and I appreciate many of the items that you brought up today. I did want to hear a little more about pharmacy. We recognize that pharmacy continues to be a problem. You pointed out some of the issues you have with specialty drugs and also different new high-cost drugs. Can you expand a little more about 10.5% being a pharmacy trend that was part of the filing for your agency? What is being done to actually try to reduce that number? Because I think we see that as an unsustainable thing going forward. It's good to hear what MGB is doing to actually look at pharmacy trends and how to actually reduce cost in the future.
Absolutely. I want to first just make sure folks really, and we've talked about this a little bit before, but giving some more tangible examples of what that pharmacy cost represents. We obviously work hard to negotiate lower pharmacy increases, and we work to manage our formulary so that we are favoring the lowest net cost products in our formulary wherever possible, while still meeting the formulary requirements of the state. Unit cost is really controlled by the manufacturer. Health plans don't contract directly with manufacturers. We contract through PBMs, but even so, it's really the manufacturer that drives the majority of those cost increases. In addition to sort of the unit cost increase on a particular drug, how much each drug is changing, the mix of drugs has a big impact. And, you know, an example is GLP-1s and diabetes. In the American Diabetes Association, recently recommended that GLP-1s be a first-line treatment for patients with cardiovascular or obesity comorbidities. That has really resulted in a shift away from prescribing some of the older, cheaper drugs. So the average cost for a GLP-1 is, after rebates and everything that we do from contracting, about $600 a month. The average cost of metformin, which was the older drug that was used as a first-line treatment, is $4 a month. So for every member in the early stages of diabetes who's used to be prescribed metformin and is now being prescribed a GLP-1, which is a substantially more effective drug. So there are health improvements that come from it in terms of A1C control. The difference in cost is $7,000 a year. That's what's getting built into our products. In the specialty drugs, the top 5 disease states account for 82% of the specialty drug spend. And these drugs are improving care, but they're just very expensive. What we're doing about it is we're working very hard on formulary design and making sure we're moving to net cost. We are working where possible to have step therapy programs and other elements to make sure that we're making sure that folks are the drugs are clinically appropriate and they're taking the lowest cost benefit for a clinically appropriate drug. But the pipeline for these drugs is continuing to grow, and the conditions that are being indications that they're being allowed is also continue to grow. And we're always in the business of getting people the healthcare that they need. We do feel like how drugs are priced is sort of a national question as opposed to even a local question. And so that is something that we continue to work on. In addition to sort of the pharmacy space, we have a lot of high cost on medical pharmacy as well. And we have been implementing programs that look at the clinical efficacy to make sure if people are getting the right drugs, and looking at site of service to sort of think about, is the drug better provided in an outpatient hospital setting, in a home setting, in a physician setting, or even sometimes directly through retail pharmacy, because the price can vary depending on the setting. So we have programs that are really looking at those elements as well.
Appreciate that. This has been very detailed. Could you go a little bit back to medical and talk about the utilization and mix for medical increasing by 5%? What your company is doing to address that? What types of cost containment may actually look to bring that down going forward?
Sure. We are, as I mentioned, and I think other folks have mentioned today, among the bigger drivers of medical trend is actually pharmacy costs that are delivered in the medical setting. So what we call medical pharmacy, and those are primarily infusion drugs. And a lot of them are for immune conditions, and then many of them are for cancer. So in 2026, we invested in a new solution to improve our management of medical pharmacy through utilization management programs, really focusing on making sure that there were appropriate indications and dosing for highly utilized high-cost drugs, and that they were supported by clinical criteria and medical evidence. We're also developing, as I mentioned, a more targeted site of care program to ensure that most cost-effective and appropriate site of care is used for infusions. And we're implementing additional claims edits in our system to ensure that there's appropriate billing of medical pharmacy claims and not any waste or coding issues there. Right now, one of the questions that we still have and we're looking to understand is how the newly amended prior authorization regulations will impact some of these programs and whether they'll be able to be as effective in the future as they have been. That's something that we're trying to understand. In addition to really medical pharmacy, we are continuously working, as I mentioned before, to improve our overall cost and utilization. And that takes a lot of different forms, really starting with product designs that are focused on driving affordability through encouraging the use of convenient and affordable sites of care in the community. We have features like Care Complement, which try to ensure, for example, use of physical therapy solutions before more expensive and actually sometimes less effective solutions for back care. We have network variance projects that try to drive members to lower cost providers through network design. We have population health management approaches to reduce chronic disease progression and individual care management programs for high-risk patients with significant needs, and a comprehensive utilization management program. We've been really making investments in technology to improve coordination between the providers and the health plan to ease administrative burden and improve care management so that we're actually working together to manage the patient and we know what each other is doing rather than working separately. And then on the provider contracting side, we're really focused on how do we ensure that we are negotiating the best contract that we can, but also providing incentives for providers to align quality and cost incentives with us through value-based arrangement. Finally, we're making investments in claims editing and fraud detection software to make sure that we're not paying for things that we really shouldn't be.
I only have two last questions. One of them has to do with negative benefit adjustment. No, pardon. A negative benefit adjustment of 1.3%. Could you elaborate on what that's caused by?
Absolutely. As my colleague from H&E explained, every year we need to evaluate the actuarial value of each plan using the updated federal actuarial value calculator, and we need to make sure that our plans fit into the permissible ranges by metal tier. Because of medical trend and inflation, if cost sharing stays exactly the same every year, and especially if with fixed dollar amounts such as copays and out-of-pocket maxes and deductibles, the actuarial value of a plan will generally go up each year, meaning that the plan is covering a greater percentage of expected medical costs versus the member. That means most of our plans end up looking like they have a higher actuarial value in the calculator than they did the previous year. And it meant that many of them actually failed the de minimis ranges for the AV calculator. That meant we needed to increase the cost sharing elements in order to meet the federal requirements by metal tier, for most plans. We also made some additional benefit changes, such as adding differential cost sharing by site of service to the connector plans to encourage members to utilize lower cost providers for services such as outpatient, radiology, and surgery, which both lowers the premium and lowers the member cost share when they utilize the lower cost provider. So that 1.3 negative benefit adjustment is the average pricing value of the change in the cost share that we made across all of these plans. And note that our files plan changes are well below the 3.6 affordability change thresholds outlined by the DOI.
The last question is about risk adjustment. There was an item in the filing for a 2.5 risk adjustment. Can you describe what that is caused by? Oh, the wrong company.
I'm not remembering that, so I'm feeling like we had an adjustment was much smaller. Okay, good.
It shows that I've got a long list of questions for each company.
You do.
The question actually for yours is about the difference between the first quarter and also the second through fourth quarter rates. The change for, I believe, the whole year is for 11.5%. But the second through fourth quarters are proposed to increase by close to 16%. Can you elaborate on that?
Absolutely. As many of my colleagues have explained further, each quarter's rate increase really represents the average rate increase for the mix of products for that period, depending on who has purchased the products and in that particular quarter. Products may have different rate increases based on benefit design changes and network factor changes. Mass General Brigham Health Plan has created a comprehensive network and product, the Select Network, that's really specifically targeted for affordability for members eligible for the connector care subsidies. And we've arranged for different provider reimbursements and a slightly smaller network for that product. We that product had a lower average increase than our other plans, driven by some of the changes in our network factors for that plan, reflecting the differences in provider reimbursement. And so since that plan is really sold to individual members, and all of our individual members renew in the first quarter, the average rate increase for Q1 is lower than the average for the other quarters, which really don't have that product.
Right, so I think that exhausts the questions that I have. I appreciate all the time you've spent today. Anything that you have to say in summation, or are we all set?
We're all set. Thank you so much for the opportunity.
I thank you very much for your time today, and I'm going to ask that representatives from Point 32, and I believe it's Jen Smagula, might actually go on screen. So I believe that you are representing both the Harvard Pilgrim Healthcare and also the Tufts Health Public Plan filings. If you, I'd appreciate if you could actually talk first about Harvard Pilgrim. Is Jen there? Just don't see you yet, Jen.
Okay. Do you see me? I think I am on screen.
There you are.
Okay, great, thank you. Yeah, so I can first speak to Harvard Pilgrim Healthcare, and good morning, everyone. Thank you, Commissioner Caljo, Deputy Commissioner Began, and the Division of Insurance for the opportunity to speak today. My name is Jen Smagula. I'm the Vice President of Commercial Pricing for Harvard Pilgrim Healthcare and for Tufts Health Public Plans. Harvard Pilgrim Health Plan and Tufts Health Public Plans are part of Point 32 Health, which serves nearly 2 million members across New England, spanning commercial, Medicare, Medicaid, and the subsidized markets. Our mission is to guide and empower healthier lives for everyone, and we're committed to offering accessible, high-quality healthcare coverage with a broad range of plan options. Harvard Pilgrim Healthcare serves approximately 80,000 individual and small group members in Massachusetts, and we offer 44 benefit plans in 2027. The average rate change for Harvard Pilgrim Healthcare in 2027 is 6.7%. The Harvard Pilgrim filing fully complies with Massachusetts' rigorous market requirements, including the 88% minimum medical loss ratio, limits on administrative expense growth, contribution to surplus constraints, and the affordability standards related to cost sharing. Our premium rates reflect the expected cost of providing care and are developed to ensure members maintain access to comprehensive, high-quality coverage. We remain committed to keeping premiums affordable and ensuring that they are developed in a manner that is reasonable, competitive, and actuarially sound. The primary driver of our rate increase continues to be the elevated medical and pharmacy claims trends, which remain significantly higher than historical levels. And in recent years, the actual cost we've experienced has materially exceeded the expectations for Harvard Pilgrim. So for example, in 2025, we experienced an actual operating loss of $11 million. So this pattern reflects sustained higher than expected healthcare claims trends, which are also continuing into 2026. So from a medical claims perspective, our trends are currently running at 10 to 11% for Harvard Pilgrim after adjusting for population changes. These trends reflect both higher unit costs and increased utilization and mix. Drivers of medical utilization and mix trend include growth in utilization and mix of inpatient med-surg services along with outpatient surgical services. We also see an increased use of behavioral health and specialty care office visits, and we're seeing a rising severity and complexity of cases, in particular with oncology care and the drugs or the injectables used to treat these more complex conditions. We're also seeing continued pressure on unit cost trends from provider requests for rate increases to help offset labor costs growth in recent years. We're seeing continued provider consolidation, shifting care into higher costing systems. And we're also seeing changes in licensure and site of care billing, which allows higher cost hospital systems to charge more for lower acuity services. So point 32 is firmly committed to the state's cost growth benchmark and to maintaining healthcare costs for our members. From a pharmacy trend perspective, our pharmacy costs remain at a significant rate and are a growing contributor to our overall healthcare spend. Through late 2025, Harvard Pilgrim trends exceeded 20%. And while discontinuing coverage for GLP-1 medications for weight loss in 2026 is expected to moderate our pharmacy growth, our pharmacy trends are still projected to remain in the low to mid-teens. And this is due to things such as new high-cost therapies, increased use of specialty medications such as anti-inflammatory drugs, and continued innovation and treatment, particularly in the areas of oncology and other chronic diseases. Point 32 is committed to improving value, affordability, and quality across the healthcare system, and we invest in a robust portfolio of cost management initiatives, in particular utilization management programs, payment integrity programs, and transition of care support. We also have an ongoing focus on our administrative cost structures. We continually evaluate and refine these programs to improve value, enhance quality, and to attempt to reduce unnecessary cost growth. So while we continue to focus our efforts on these initiatives, medical and pharmacy trends have continued to drive higher overall healthcare spending. And our filing reflects these ongoing cost pressures and are necessary to ensure continued access to comprehensive, high-quality coverage for our members. Thank you for the opportunity to speak about Harvard Pilgrim. I believe you may have some questions before we would turn over to the Tufts Health Public Plan filing.
I do. Thank you very much. I think I've asked a few companies. I do want to hear also the perspective of Harvard Pilgrim. The benchmark is 3.6%. In the filing, obviously your trend is higher. You've talked a good deal about the pressures of consolidation, about hospital labor costs. Help me to understand why plans aren't able to actually bring down their reimbursement rates so that they're at the benchmark level. I think this is one of the challenges that we consistently find in the market. The benchmark is something that's set, and then we find that plans are filing and demonstrating that they have trends that are much above the benchmark.
Yeah, so as I mentioned, we are committed to the state's cost growth benchmark and to using that to maintain affordable healthcare costs. We do continue to receive aggressive provider rate demands, and we have strengthened our negotiation strategies, our processes, and the data to support that. But at the same time, certain providers must remain in our network in order to preserve member access and to meet network adequacy requirements. And again, I'll just highlight some of the significant drivers I mentioned previously as to why the rate increases we receive are higher than the benchmark, and those are related to increasing costs to offset the labor cost growth, provider consolidation, which generally shifts care to higher cost systems, and then also the changes in licensure and site of care billing practices I mentioned. So although provider cost increases have continued to exceed the state's cost growth benchmark, we have been successful in maintaining some large provider systems at or below the benchmark, and we continue to work at this in every contracting cycle we go through.
Related regarding pharmacy trend, highlighted many of the concerns about the rising costs. Can you go a little further? Because some of the things you mentioned about how carriers really don't have this direct control of what the cost increases are and how that impacts the rates.
Yes, so I mentioned this as well. Our pharmacy trends were running through the high 20s through the end of 2025. And as you know, we have discontinued coverage of GLP-1 medications for weight loss. So that is leading to some moderation in our pharmacy trends, but they're still expected to be in the low to mid-teens. So we do partner with our pharmacy benefit manager to do everything we can from a contracting perspective to help mitigate the high cost of pharmacy claims. But I think, as others have mentioned, that it's really the drug manufacturers who set the prices for these drugs. And there continues to be high cost specialty medications which are being introduced, and sometimes these can cost in the hundreds of thousands of dollars for just one course of treatment. There's also evidence that manufacturers will increase drug prices for drugs that have already been on the market for a period of time. So those lead to higher costs and that's what's driving a lot of our pharmacy trend. But in addition to just the price of drugs, it's also the mix of drugs, the types of drugs that are being utilized by our members that are driving our higher pharmacy trends. And these can have a significant impact on the pharmacy trend as well. And then I would just lastly say, we do also work to assess our PBM's pricing from a contractual and competitiveness on a regular basis. We go through that process through a structured market check process.
One thing that shows up in the filing is a medical utilization and mix rate change of 7.2%, which I think alludes to much of what you've talked about with rising med surg, outpatient surgery, behavioral health, specialty type care. What types of things are Harvard Pilgrim doing to actually address some of the rising mix and intensity issues in order to reduce unnecessary and inappropriate utilization?
We do have a robust portfolio of cost management programs, and we have a cross-functional team that's continuing to evaluate and look at these programs and where we can modify them or add them to continue to try to find ways to improve value, along with affordability and quality of care. So the programs that we focus on or that I would highlight are our utilization management programs, payment integrity program, so making sure that the claims are getting paid in the right way. For those who are dealing with more high cost conditions, we have complex care management programs, transitions of care program as people are moving from one setting to another, from an inpatient care setting to a rehab or at home setting. And then the other thing I would just highlight is also we have a continued focus on our administrative cost structure as a way to keep our premiums affordable. So despite all these efforts, our trends have been emerging at the elevated levels that I've been referring to, but we do continue to look at these programs closely and find ways to try to enhance or react to new information that's coming through our medical management teams.
The next question has to do with administrative charges that are shown as drivers of rate change. I know in looking in the filing, it appeared that Harvard Pilgrim had administrative charges that had a negative 1.2. Is there a way you can elaborate on what that actually includes?
So we develop our administrative cost charges, and these are meant to cover expected administrative costs for the upcoming year. So these administrative costs will include things like overall general admin, claims operations, marketing, distribution, network operations, and then and quality improvement expenses. So that minus 1.2, that represents how much the change in our administrative charges impact our overall rate increase of 6.7. And the minus signs means that our administrative charges are decreasing and that they're making our rate increase lower than it otherwise would have been. And this reflects all the efforts that our company is doing. And it's very taking a disciplined approach and managing our administrative costs.
I think you exhausted my questions for Harvard Pilgrim. Any final thoughts you wanted to put in regarding Harvard Pilgrim before moving on to Tufts?
I am all set.
Sorry to do two at the same time, but it seemed to be more efficient rather than having you come back and forth. So switching gears, can you describe a little bit for everyone on the video about the difference between Tufts Health Public Plan and Harvard Pilgrim in the market?
Yes, happy to do that. So Tufts Health Public Plan, along with Harvard Pilgrim, is part of point 32. And again, we serve over 2 million members across New England, serving commercial, Medicare, Medicaid, and the subsidized markets. Tufts Health Public Plan serves approximately 160,000 members in the individual and small group markets, and we will be offering 8 benefit plans in 2027. The average calendar year rate increase for THPP is 11.8%. And this filing also fully complies with the Massachusetts rigorous market requirements. So the 88% minimum medical loss ratio, limits on administrative expense growth, limits on the contribution to surplus, and also the affordability standards related to cost sharing. So similar to the Harvard Pilgrim filing, the primary driver of the rate increase is the elevated medical and pharmacy claims trends, which continue to remain higher than historical levels. And our actual cost expectations for THPP has exceeded expectations. In 2025, the THPP is experiencing an operating loss of $35 million. So medical trends for THPP are running in the 9 to 10% range, and this is after adjusting for population changes. The drivers of our medical trend are similar between THPP and Harvard Pilgrim, so things such as use of inpatient services, behavioral health, specialty care visits, and then the rising rate of complexity, complex care cases, in particular oncology care. And then also similar to Harvard Pilgrim, we are seeing unit cost pressure from our providers driven by similar factors such as where the request for rate increases related to labor cost growth on the provider side, and then also provider consolidation. From a pharmacy trend perspective, we're seeing through the end of 2025, THPP was seeing pharmacy trends in the high teens. Similar to Harvard Pilgrim, we also discontinued coverage for GLP-1 for weight loss in 2026. So this is moderating our pharmacy trends, but we're still expecting them to be in the low to mid-teens. And the drivers are similar on the Harvard Pilgrim side as far as new high-cost therapies, increased use of specialty medications, and then just the continued innovation and treatment and new drugs coming off the market. The one other factor I would highlight that is different in the THPP side than the Harvard Pilgrim side is the impact from the expiration of the enhanced federal premium subsidies, the changes from the One Big Beautiful Bill, and the resulting changes to the Connect Your Care programs are also impacting our enrollment and risk mix. And this is placing additional upward pressure on our rates. And this is different from the Harvard Pilgrim side because on the THPP side, we do cover a large number of subsidized members that are impacted by these subsidies changes and Connect Your Care program changes. On the THPP side, we do have a focus on our cost management program, so similar to the ones I've highlighted related to utilization management, payment integrity, and also ongoing administrative cost discipline approach. So this highlights the differences or everything I wanted to mention related to the THPP filing, and I can also take questions at this time.
Appreciate it. Just to state the obvious, these are separate companies. They are separate populations. In each of these companies, as you develop the rates, they are looked at separately because you need to develop the rates specific for the individuals that are in the populations. Can you just go over, and I think it's one just to state the obvious, why would the trends be different, for instance, for pharmacy, for the Harvard Pilgrim population than for the Tufts Health Public Plan population?
So as you state, even the Harvard Pilgrim and THPP are both under the 0.32 corporate entity. They are separate populations, separate plan designs, and the rates are developed separately. So on the pharmacy side, there are different types of members using different types of drugs, and the cost of the drugs can also vary. They're separate provider contracts in certain cases as well. So they're set separately. The rates are set separately based on those populations.
So it's not, again, that it's just this one fixed number you have with your PBM that you're negotiating. It really is based upon the population in each of the separate companies.
Correct.
Appreciate that. Even with that, similar to what you've heard from other companies and even that we discussed with Harvard Pilgrim, is there anything more that you'd elaborate on any of the cost pressures with the 3.6% benchmark and also providers and any of the providers inside the THPP system that may cause reasons why you would ever contract for rate increases above the 3.6% goal?
It is similar. We're seeing similar conversations, similar pressure on the THPP side as we are on the Harvard Pilgrim side, and we are getting requests for rate increases above the 3.6% benchmark. And in some cases, we are able to negotiate something at or below the benchmark, but we are not able to do that in all cases, and have to meet network adequacy requirements on both populations. So we are working at it and committed to it, but it is challenging. I guess the other thing I can highlight, though, on the THPP side, we did have to make the difficult decision to terminate our relationships with two large entities effective 1/1/2025, and that was as a result of some difficult provider contract discussions that occurred with that on the THPP side.
Thank you. And on the pharmacy side, you use the same PBM for both Harvard Pilgrim and for Tufts Health Public Plan. So many of the items you mentioned regarding how you're trying to address PBM increases is actually something that applies both to THPP and to also Harvard Pilgrim. There are no other additional things that are specific to THPP?
Correct. It's similar market kind of dynamics happening on the THPP side.
And it's a comparable question regarding cost containment steps you may be taking in order to address medical utilization and mix rates. We know the medical mix rates reflect growing intensity and severity of costs. Is what you're implementing on the Harvard Pilgrim side being implemented likewise on the same Tufts Health Public Plan side to address any unnecessary and inappropriate utilization?
Correct. We do look at each population separately, so we try to tailor what we're doing in the program specific to if there's any differences we're seeing. But yes, we take a similar approach as far as how the types of cost management programs or care management programs that we're looking at and implementing on both populations.
And is there anything special about Tufts Health Public Plan's utilization management or programs that's different from Harvard, you point out?
Nothing that I can think of to highlight, but I do know also in our rate filings, we include a lot of detail for each company about the types of programs we've had. But yeah, nothing immediate comes to mind to highlight.
And my last question just is about benefit adjustments within the filing for THPP. I believe there was a benefit adjustment that was for a negative 2.8%. Can you elaborate on what that is?
Yes, similar to what some of the other companies have highlighted, there are benefit changes that are needed in a given year in order to comply with the federal AV requirements. And in addition, a lot of most of the plans on the THPP side are standardized plans by the connector, and there were changes made to the cost sharing for some of those plans. So that benefit adjustment also reflects the changes that were made to the cost sharing on the standardized plans.
So I know the number is a little higher than for other companies, and I know we've heard other companies mention much of their change was associated with fitting within the ranges? It sounds like the THPP one may be more associated with connector change the standardized plans.
Yes, but we also do have a non-standardized plan that we had to increase some of the cost sharing on. So I would say it's a combination of both.
Okay, thank you very much. Again, thank you for presenting for both companies. Is there any final word you've got for THPP?
Nope, just to thank you for the opportunity to be here and the continued collaboration between our company and your department.
Appreciate that. Thank you very much. I'm going to ask if United Healthcare, I believe it's Mike Dubrowski, could go on screen right now. Thank you very much, Tim.
Yep, good morning, and thank you for the opportunity to speak today. My name is Mike Dubrowski.
I hope you don't mind going last again, Mike. Is that okay?
No, totally fine.
Thank you.
I appreciate to be
for
able to speak. Yep. Good morning, and thank you for the opportunity to speak today. My name is Mike Dubrowski, and I'm the actuary responsible for the 2027 merge market rate filing for United Healthcare. We appreciate the division's review and the chance to explain the need for our proposed 2027 rates. It is a privilege to serve over 20,000 small group and individual members in the state of Massachusetts, and we take that responsibility seriously. It is our mission to help people live healthier lives and make the healthcare system work better for everyone. Today, I will provide an overview of our products, discuss our proposed 2027 rate changes, and explain the key drivers impacting those rates. United Healthcare offers a full range of health benefits, enabling affordable coverage, simplifying the healthcare experience, and delivering access to high-quality care. In Massachusetts, we offer 52 unique medical plans across all metal tiers to small group employees and individuals. These include plans that can be purchased through brokers and agents or directly, as well as plans that are offered on the Massachusetts Health Connector. All plans are available statewide. We offer two different product types: POS plans, which allow members to see providers both in and out network, and EPOs, which require members to see in-network providers. As a national carrier, all United Healthcare plans allow national access to one of the largest provider networks in the nation. We currently serve over 21,000 small group and individual members in Massachusetts. We understand that there are many options available when selecting a health insurer, and we are very grateful to have the opportunity to serve you. United Healthcare is requesting an average year-over-year rate increase of 14.2% for 2027. Actual changes vary by plan, ranging from a 13% decrease to a 26% increase. This rate request reflects the continued increase in underlying medical and pharmacy costs. In 2025, UHC's claim costs increased by 13% compared to 2024. While we work to remain competitive in Massachusetts, it is critical that our rates remain actuarially sound and adequate to cover expected claims and expenses. These rising medical costs expand across many services, but some of the biggest drivers include outpatient surgery, inpatient surgery, infusion services, specialty drugs, emergency care, behavioral health services, and physician office visits. Provider contract negotiations continue to be a significant contributor to cost increases. In some cases, negotiated increases exceed statewide cost growth benchmarks. These increases, combined with higher utilization, place significant pressure on our medical trend projections. Massachusetts' law requires that 88% of premium dollars are directly spent on medical services and programs that improve healthcare quality. If this requirement is not met, carriers are required to offer rebates to members. Under our proposed 2027 rates, we project that approximately 89% of premium dollars will be spent directly on medical care and quality improvement initiatives. We feel fortunate to be able to work alongside a division of insurance that emphasizes the importance that rates should not be excessive, inadequate, nor unfairly discriminatory. I'm confident that our requested rate filing meets each of these criteria. We also recognize that affordability is a central concern for members, employers, and the Commonwealth. United Healthcare continues to prioritize affordability through a range of initiatives, including virtual care programs, specialty pharmacy management, network strategy, care management, and value-based care arrangements. These efforts are designed to improve outcomes while lowering the total cost of care for members and employers across the Commonwealth. We are grateful for the trust members place in us and for the division's continued collaboration throughout the rate review process. We appreciate the opportunity to present our filing today and look forward to answering any questions you may have. Thank you.
Thank you very much, Mike. Appreciate your time. And obviously, you give a perspective on a national level that the other companies cannot always give. I know that you've heard many questions have been raised about the benchmark. We have a 3.6% benchmark. I think that we have consistently asked questions why companies can't negotiate rates to that benchmark. You have perspective not only in Massachusetts, but also in other jurisdictions. Can you elaborate on some of the reasons why United Healthcare has not been able to negotiate rates at a 3.6% benchmark level?
Yeah, thank you for the question. I think it's important to understand that the HPC benchmark and our medical trend measure two different things. The benchmark is a statewide target across all payers, and it does include Medicare and Medicaid, while our trend reflects the expected costs for our specific commercial population. In addition, our medical trend is driven by both increases of the price of service and the utilization of care. And currently, utilization is driving a significant portion of our trend. While we support the goals of the HPC benchmark, we're required to develop rates using the best estimate of expected future costs. If we were to assume a trend consistent with the benchmark rather than observe the experience, our rates would not be adequate to cover claims. With respect to the provider contracts, we do operate in a competitive environment where maintaining access to high quality providers is essential for our members. In some cases, providers seek increases above the benchmark, and we must balance affordability with ensuring that members continue to have access to comprehensive high quality care. It would be nice to have the speakers or the providers speak a little bit about why they don't always accept rates below the benchmark. I know last year they mentioned that sometimes they're offsetting Medicare and Medicaid contracts, and there's a variety of reasons, but obviously they have quite a bit of negotiation power in this situation. So while the benchmark is an important policy goal, our rate filing reflects what we expect those costs to be for our members.
Thank you. Also want to dig into the pharmacy. We know the pharmacy trend for your company is 14.6%. We want to understand the reasons why your company may agree to levels of contracts with your PBM that actually lead to such high trend. You've gone through some of the concerns you've had with things going forward. We know pharmacies, you've heard me mention many times, is leading a lot of the unsustainable cost increases. I'd like to hear how your company thinks this is actually evolving and how to mitigate really pharmacy trend changes.
Yeah, thank you again for the question. Again, the pharmacy trend is primarily driven by rising drug costs and increased use of medication. In this case, a lot of the driver of the trend is an increase in utilization. Right now, that is 9.7% of our pharmacy trend. And a key driver of the growing use of specialty medications and newer therapies, which are often very expensive but necessary to treat complex conditions. We actively work to manage these costs through formularies, rebates, and utilization controls, but those efforts do not fully offset the underlying cost increases, especially when a significant portion of it is driven by utilization. So as a result, the trend we filed reflects the actual growth in pharmacy costs that we are seeing.
So the one thing you've heard me ask many companies about is the utilization and mix rate. And according to my understanding of the filing, United filed for the utilization mix rate for medical to increase by 7.5% and for pharmacy to increase by 10.3%. Can you just elaborate on how United Healthcare already has cost containment programs in order to reduce inappropriate or unnecessary care, and what's being done to look for ways to even further decrease the severity and intensity changes that seem to be part of the filing?
Yeah, thank you again for the question. The projected increase in utilization reflects growing demand for care and more complex treatment patterns. On the medical side, we're seeing more use of services like outpatient surgery, inpatient surgery, behavioral health, and physician offices. And for pharmacy, increased use of specialty drugs is a major driver. At the same time, we're actively working to manage utilization and ensure care is appropriate. This includes care management programs for high-risk members and network strategies that promote high-quality, cost-effective care. I also earlier did go through some of the items that we do in more detail, but we do have several initiatives in place to help make sure that utilization remains low while ensuring that members do get high-quality, cost-effective care.
I think the last question, Mike, is just to really understand benefits. And I know that your filing includes a negative 1.6% benefit adjustment. Can you elaborate on what that entails?
Yeah, similar to what many other insurers have mentioned, the negative 1.6% adjustment is mainly due to plan design changes needed to meet the federal actuarial value requirements. Each year, we are required to adjust plan designs such as deductibles and co-payments to ensure that plans remain within their required metal tiers. For 2027, those changes result in slightly higher member cost sharing, which reduces the projected claim costs and also reduces the premiums.
So last just question, and you may or may not be able to answer this. Is Massachusetts unique? Are some of these cost pressures similar to what is being seen in other states, or is Massachusetts got unique challenges that is causing the changes that were filed?
Yeah, I would say that Massachusetts is not unique. There's pressures everywhere right now. There are some unique things about the Massachusetts filing. Obviously, it's a merged market. There's also various other items that are unique. The one that comes to mind is the loss ratio requirement of 88%. That's significantly higher than the federal requirement of 80%. So that while there are some unique pieces of Massachusetts specifically, the pressures I think are being seen everywhere and by other carriers as well, based on some early indications that I've seen.
So some of the pharmacy and also medical trend changes are things you're seeing in other jurisdictions too.
Yeah, I can't speak across the board, but I do work on a few other markets, and I know that we've seen some similar pressures.
Thank you very much for your time. Any final comments?
No, just want to say thank you again, both to our members and to you and your team as well.
Well, thank you very much. This concludes actually the discussion by all the carriers regarding their products, their filings. Just a 5-minute break until 11:25 to give a chance for the public to become available. We will ask if there are any public individuals that are elected officials that want to speak. And then we do have a list of pre-identified speakers. John Hurst from the Retailers Association, Liz Leahy from the Mass Association of Health Plans. I apologize. John Hurst from the Retailers Association, Peter Knowlton from the Mass Care Board, Christopher Carlozzi from the National Federation for Independent Business, and Alex Sheff from Healthcare for All. We'll start at 11:25. I'd ask that those speakers become available so we could listen to their comments, and it'll give time for a short break. Thank you again. We'll just go on break for 5 minutes until 11:25. Hello, and it's now 11:25, and I'm going to revert back to the public session. So thank you again for taking a break. In the interim, I was able to confirm that the speakers include John Hurst, Christopher Carlozzi, Alex Sheff, and Liz Leahy. So unfortunately, my list was a little mixed up. They are the 5 speakers. Before I begin the public information session, I want to invite any public or elected officials who may want to present their comments. Are there any public or elected officials in attendance today who would like to speak? Okay, seeing none. The next group of speakers are, again, those individuals who had commented that they wanted to present information at the Division of Insurance. We ask that the speakers adhere to a 10 to 15 minute time frame when speaking and answering questions. I'd ask that our first speaker, if he is available, is John Hurst. John Hurst is from the Retailers Association of Massachusetts. Mr. Hurst, are you available?
I am. Good morning, Kevin and Commissioner and the DOI team. I appreciate this time. I appreciate your efforts, and we meet again. We've been doing this for several years ago, and it seems like we've been facing the very same problem year after year after year. One thing that is a little different this year, Commissioner and Kevin, is that 2 months ago we, quote, celebrated the 20th anniversary of Chapter 58. That celebration did not occur on Main Street, Massachusetts, nor did it occur for real premium payers, nor did it occur for real taxpayers. In fact, what we've seen over this 20 years is a death spiral in the merged marketplace. We've seen just unaffordable medical inflation, unaffordable premiums going up year after year after year. We've been surveying our 4,000 members each and every year over that 20-year period. Our members have seen an average of 11% increases each and every year. The only way to mitigate that is to do massive cost sharing that we've seen. We've all seen that occur in order to keep the premium somewhat affordable and in single digits. And that 11% average, keep in mind that is 4.5 times the average annual inflation rate. It's 3.25 times the average HPC benchmark. It's 2.33 times the average GIC increase. That's catastrophic. And trust me, Main Street employers and their workforces are not celebrating the 20th anniversary of Chapter 58, nor are the voters. We just completed a public opinion poll of 600 voters across the Commonwealth of likely voters. 75% believe that Chapter 58, the individual mandate and taxpayer mandate, should be repealed because it has been too costly. 87% believe that state health insurance mandates should be rolled back. Clearly, the public sees the public policy failures, even if Beacon Hill does not. Now, so what do we do? In short, we have a situation in which we have inadequate regulation, and that's not DOI's fault. DOI must live with the playing field that is created by Beacon Hill. And nor do we have really strong consumer protections and strong consumer choices in the marketplace. Too many of the decisions are made by government themselves. So we've got to do something to rein in this massive medical inflation because we do have an affordability crisis. Short term, we would recommend, hate to say this, but we believe the DOI should deny these rate increases. These average 13% rate increases force the insurers and the big providers and the big pharma back to the negotiating table, because frankly, this is the only tool that we have at our disposal right now. And frankly, these annual increases are going to continue until we say they can no longer continue. They can no longer continue. We must say no. Another thing that the DOI can do, we believe that we should require full transparency of the contracts between the insurers and providers. Having them not be public hasn't worked. We understand the arguments well, okay, if you pay this provider this, someone else is going to want the same thing. Well, that hasn't worked. So why not impose some public shaming on these high cost providers? We also could use some full transparency of insurer contracts with providers when they have different rates depending on the different risk pools. So if you have risk pools at different rates, reimbursement rates, say a fully insured rate versus a self-insured rate versus a government risk pool rate, I think the public has the right to know that they are reimbursing at different levels depending on those risk pools, because that can indeed allow for unreasonable cost shifting. But these are short-term efforts that the DOI can do. What we need to do longer term for 2027 is that we've got to give small businesses and the workforce a reason to stay in the merged marketplace, stay fully insured, because right now public policy is incenting them to leave. And you do that by getting rid of the discrimination that is clear under the law. You can do that by demerging. Only in Massachusetts do we have this merged marketplace, which has gotten worse with the loss of rating factors. When we don't have rating factors, we don't allow small businesses and the workforces to have fair administrative and actuarial rates. Without those fair rates, they are forced to unfairly cross-subsidize individuals. And by the way, many of these individuals already are getting very generous subsidies from the taxpayer through the connector, and those subsidies, taxpayer-provided subsidies, are not available to small groups. So why in the world are we continuing to require higher premiums at a time when the individuals are getting taxpayer subsidies? We also need to look at giving premium payers the right to choose on state mandates. We're at 59 now. There's going to be a debate this week on what could be the 60th mandate on Beacon Hill. And that could be a very costly one. And state mandates, let's keep in mind, do not treat all premium payers fairly. If you're risk exempt versus fully insured, there's a different playing field on how much whether you follow them and whether you can impose cost guardrails. And we do know now that these state mandates can be up to 24% of premiums. That is simply unaffordable. And it's taking away the freedom of choice for consumers, the only tool that they really have to try to buy what they can afford, what they really need, and what they will actually use. And finally, I think what we ultimately what we have to do, you can't really totally blame the insurers on this, although I think they can do a better job at the negotiating table, clearly with the providers. But ultimately, we do need a real discussion, and we need to do something about creating a provider rate cap, probably tied in with Medicare rates. With that, I want to thank you for your attention on this. This is a very important issue. Affordability is the key issue with voters and small businesses across the Commonwealth, and nothing is less affordable today than health insurance premiums, particularly for the small business and the workforces, and it's putting them at risk and at a competitive disadvantage versus other workforces and other larger employers. So thank you for your efforts on this.
Thank you very much for being here today, John. We are aware you're involved in many other groups that are looking at affordability and appreciate your perspective today. Obviously, anything that you even want to put in writing regarding this, we always take into heart. We look through the rate filings. Thank you. Our second speaker is Peter Knowlton, who is identified as a Mass Care Board member and a retired general president of UE. I don't know, is Mr. Knowlton available?
Yes, I'm here.
Appreciate it. I did not quickly see you in the list of participants. The floor is yours. Thank you.
Okay, thank you very much. Thank you for the opportunity to speak. My name is Peter Knowlton. I live in Dartmouth. I'm a board member of Mass Care, which is the coalition whose mission, is the passage of the legislation titled Medicare for All in Massachusetts. For 35 years, I was a member of the United Electrical, Radio, and Machine Workers of America, the UE, and retired in 2019 after serving 4 years as the national president. The Division of Insurance should resist the approval of any increased payments of health insurance on Massachusetts residents. The wealthiest and the poorest among us are the only ones not directly affected by your decision. The wealthy, because health insurance costs are essentially pocket change, and ironically, those of the poorest among us who receive and benefit from the wonderful work of Mass Health and enjoy some of the best health insurance in the country. The merged market covers only 15% of the residents who have insurance, including Mass Health. But you set the tone for how the insurance companies approach their subscribers in other markets, including schools, towns, cities, counties, and the state. If the division grants the industry their increases, rest assured, those rate increases will cascade onto the rest of us throughout the state. The buck does start with you. There is no meaningful accountability or transparency for the healthcare industry that consumes $128 billion a year. MassCare is comprised of leaders in the labor movement who negotiate regularly with health insurance companies for their members, as well as hospital and healthcare professionals and workers, insurance professionals from the industry, employers and elected officials who face the pressures of layoffs versus health insurance increases when negotiating with brokers or an insurance company, and academics and others who have spent their careers studying healthcare and finance policy. MassCare members and leaders are seasoned consumers of healthcare and working with the system we have now. We know from where we speak. Increases to health insurance will unfairly affect lower income workers the worst. We finance our healthcare system in an extraordinarily regressive manner. The less you make, the more of your income you pay. Excuse me. An executive at two of the largest health insurance companies, Blue Cross Blue Shield or Point32, Pilgrim and Tufts, with an average salary of around $5 million, would pay 1/2 of 1% of their income based on the proposed premium increases for the family plan presently offered by the GIC, Government Insurance Commission. But someone making $60,000 a year will be paying 41% of their income, a devastating reality for working people. Health insurance and care is in crisis, especially since the private equity Stewart fiasco, and those whose financial stake in the system is already enormous are asking workers and taxpayers for more. To pay into a system that discourages care by financially penalizing us with copays, deductibles, and denials. How can you justify premium increases when companies have negotiated drug and hospital prices so poorly? Why should subscribers be held hostage for that? If the insurance companies can't negotiate better prices from big pharma, it makes sense that those responsible should absorb and be held to account for their failings. The lack of transparency in health insurance company provider costs, reimbursement agreements, is another reason to reject any increases. We don't know what the agreements are for the payment of provider services, and yet we, their subscribers, are expected to cough up more cash from some ill-defined spreadsheet. Small employers in particular are being hammered by health insurance costs. 41% of small businesses don't or can't provide health insurance, one can assume, because they cannot afford to provide private health insurance. But even more importantly, if they do provide it, there is no guarantee to them of health insurance cost and price stability. Large corporations have ways to absorb, hide, or deal with these increased costs, but small businesses do not. Health insurance cost increases are the same as taxes, only worse, as we finance healthcare in the most costly, inefficient, and regressive way possible. And like taxes, the effect will be an increased deduction directly from our paychecks. There should be no approval of increases to an industry that is incapable of providing affordable health insurance with complete coverage for all residents of Massachusetts. The Division of Insurance should send a message on behalf of Massachusetts residents that you have our backs and reject any increases to the merged market premium tax rates. Thank you very much. Appreciate it.
Thank you very much, Mr. Knowlton. I definitely appreciate your comments. We recognize how the small group individual market impacts some of the most difficult arrangements. We share many of your thoughts. We know there are many different groups that are looking at affordability. We appreciate even your comments regarding how we should proceed this year. There's only one thing that I would highlight, whether it works well or not. Whenever anyone does get care, there is a requirement under the law that they do get an EOB that does express what the different costs are that the providers have and also that the carriers do pay. I don't think that goes far enough. That transparency of costs needs to be more clear. But we appreciate your thoughts, want to make sure that they're taken into account as we're looking at the filing. We appreciate today. Anything more you'd want to add?
No, thank you for your time. I appreciate it. The only thing that I would just like to raise is that I'm not so much, I am talking about the cost that we're charged, but I'm more talking about the rates that are negotiated between the provider and the health insurance company. Those are not transparent. We don't know what those are.
Understood.
Thank you.
All right, well, thank you again. Our next
Appreciate
speaker is, thank you again. Our next speaker is Christopher Carlozzi, the Mass Director of the NAS Federation for Independent Business. Chris, are you available?
I am. Thank you very much.
Thank you.
I want to thank the commissioner and to you, Deputy Commissioner, for the opportunity today to speak. As you said, my name is Christopher Carlozzi. I am the Massachusetts Director of the National Federation of Independent Business, and we represent thousands of small and independent business owners really involved in a wide range of industries, manufacturing, retail, wholesale, service, agriculture. And I just want to comment on how rising health insurance expenses, they're not just becoming a larger and larger portion of a small business's budget, but they're also hindering attempts to attract workers as they compete for talent with larger companies and government. One of the biggest problems our members face right now is trying to staff their business. So last spring, we surveyed our members, our Massachusetts members, seeking a better understanding of their health insurance challenges and asked them to provide comments and give us some feedback. And we used this for the HPC cost growth benchmark hearing. And it was unsurprising, the results. We found that about 100% of those, so all of them that replied to the survey, maybe because they had a vested interest, they did experience a premium increase in 2026. But I think what stood out as the most shocking takeaway was that a third of those that reported the increases saw their premium rise by more than 20%. And this seems to be far more dramatic an increase than past years, usually ranging between 9 to 13% on average. But to see that portion, at over 20% was telling. State data cited premiums for individuals and small group plans offered in the merged market increased by an average of 7.9% for 2025 and 13.4% for 2026. So we were seeing our members far above that. Health expenses growing at this rate, it's simply unsustainable for smaller employers. Looking at the proposed rate increases for next year, it seems employers may be on track to even higher rates if nothing is done. One business owner replied to us in our survey, and I took the quote because I found it somewhat summing up the situation tragically well, that health insurance is becoming unaffordable. It's no longer a benefit because not only has the cost of the premium increased over the years, but the amount of coverage has also decreased with higher deductibles and the addition of co-insurance payments. Every 4 years, NFIB surveys our members nationwide to determine our top list of problems and priorities. And since 1986, the cost of healthcare has topped that list. And when the cost of offering health insurance rises for a small business, it means less money to use for other incentives for workers like 401ks, time off, other benefits. Those are crowded out. We're once again seeing health growth spending far exceed the state cost growth benchmark this year, and small businesses are seeing their premiums continue to skyrocket. In 2025, NFIB issued a white paper on health affordability, which appears to correspond with CHIA's data on employers no longer offering coverage in what many describe as a death spiral for the small group market. Again, CHIA's 2026 report show both small and mid-sized group enrollment drop. It seems from the newest CHIA data that even fewer lives are being covered in the small group category. So we feel that policymakers must also examine the impact of the unique Massachusetts merged market on smaller employers. John Hurst kind of touched upon this a little earlier, but as of February 2025, Vermont no longer has a merged small group and individual health insurance market. They ended their merged market, and that just leaves Massachusetts and Maine as the only two states in the nation that utilize this structure. According to reports, this experiment seems to be failing in Maine as premiums continue to increase there. Vermont lawmakers voted to permanently unmerge, something Massachusetts should really consider. And in testimony presented to Vermont lawmakers, it was noted that over $4.1 million in cost was being shifted to small businesses. The testimony provided in that state also noted merging the markets burdened Vermont small employers with $17.7 million of costs beyond those needed to cover their own health care. Looking at today's proposed rates, it's clear why small businesses consistently experience double-digit premium increases. But Massachusetts must look at the underlying policies driving up the cost, including inquiring how the merged market makes it disproportionately worse for smaller employers. Like Vermont demonstrated, cross-subsidizing within the merged market places small businesses at an unfair disadvantage. Finally, lawmakers must avoid the urge to advance more new mandates that represent an ever-growing portion of every premium dollar. There are now more than 50, almost 60 state-mandated health benefits in Massachusetts that extend beyond what the Affordable Care Act requires. And as John noted earlier, while larger self-insured businesses are immune to the impacts of these, small businesses are not. And that could become infinitely more difficult and worse if that discussed primary care mandate being talked about rolls out in a way that causes premiums to rise further because of increased spending. So Beacon Hill policy does play a large part into what's happening here too, and that can't be ignored. So for too long, small businesses have heard Massachusetts needs to be a more competitive and affordable state, and that goes for healthcare costs as well. But that will require Beacon Hill policies that rein in health costs so that employers are finally able to offer their workers an affordable health benefit. So I thank you for the time today, and just want to really raise the flag that small businesses are just dealing with these premium increases at an alarming rate that are unsustainable at this point. So thank you.
Yeah, thank you, Chris, for being here today. I appreciate it. I think we're going to ask the next speaker. So thank you. Alex Sheff, Senior Director, Policy and Government Relations for Healthcare for All. Are you here today?
I'm here. Can you hear and see me?
I hear you, and now I see you.
Okay, great. Thank you, Deputy Commissioner Began, for the opportunity to speak today. As you said, my name is Alex Sheff. I'm Senior Director of Policy and Government Relations at Healthcare for All. As many of you know, we are a statewide consumer health advocacy organization, and among other things, we operate an enrollment helpline that takes over 20,000 calls a year in 5 languages. Every day, our helpline counselors hear from people who are struggling to pay their premiums and the high out-of-pocket costs of their healthcare. These financial pressures often force people to make difficult decisions about their coverage, like enrolling in the cheapest plan option, which might not adequately cover their healthcare needs, or worse, foregoing coverage altogether. And we've heard a lot of those calls over the last several months. This year's average proposed increase comes on the heels of last year's double-digit average rate increase. This is an unsustainable rate of growth. Individuals and families in the Commonwealth simply cannot keep up. The proposed average rate increase of 12.9% is well above the health care cost growth benchmark, as has been discussed extensively, as well as wage growth in Massachusetts. And it comes at a time when consumers are also facing skyrocketing premium increases caused by the loss of federal subsidies, which is also an important dynamic that's happening simultaneously here for consumers. Recently, our helpline heard from a breast cancer patient whose premium had climbed to $835 a month. She can't go without coverage, and said she would rather cut back on food than drop her coverage. Another family we heard from is facing an 81% premium increase due to both rising premiums and the loss of federal subsidies in combination. Their daughter has a chronic medical condition, and they want to avoid disrupting her care with the providers in their network, but they don't know how they can afford the premium increase. As the division reviews the proposed increases, we urge you to consider their impact on affordability for Massachusetts families, individuals, and small businesses as you consider actuarial soundness and solvency as well. Both are an important part of this calculus. As in past years, Healthcare for All worked with an actuary to analyze the rates filed by carriers, and we want to highlight a few areas we think warrant additional exploration from the division. First, we would encourage the division to seek to better understand the impact of discontinued GLP-1 coverage for weight management. Nearly every carrier has discontinued coverage for GLP-1s for weight management, but we, at least in the public space, haven't seen the savings from this change quantified for this plan year yet. We want to make sure that gets explored. Second, we urge the division to consider how administrative load and contribution to surplus assumptions are determined, and in particular, the role that state thresholds play compared with market pressures. In other words, is there enough competition here? We want to better understand the consistency in nearly all carriers assuming the same maximum 1.9% contribution to surplus. Given that different carriers likely have different levels of risk-based capital reserves, we might expect to see some variation in a year with exceptional premium rate increases like we're seeing. Additionally, though there appears to be some reclassification between expense categories, administrative costs in combination with taxes and fees seem to continue to increase consistently year over year with trend, without clear explanation for why they would be correlated with a significant increase in medical trend. We therefore urge the division to seek additional information regarding the breakdown of these administrative costs. While we recognize the challenging environment, we ultimately suggest rates should not be approved until there is further exploration and understanding of these questions. At the same time, it's clear from the filings that the vast majority of premium growth is being driven by the increase in underlying healthcare costs. There are several clear drivers of premium rate growth that nearly every plan articulated in their filings: medical and pharmacy trend. As we all know, this is not a new story. Pharmacy costs, in particular, with an average trend rate of 12.7%, appeared to be the leading driver of premium growth and continues to point towards the necessity for state intervention. With respect to medical trend, provider unit costs were also cited by many carriers as a key driver of costs, and the prevalence of provider unit cost increases raises concerns about the degree of effective competition in the market, which should be putting downward pressure on price growth. And we heard specifically from plans about regional lack of competition and the challenges that poses for their negotiations. One approach that warrants consideration in Massachusetts is reference pricing, establishing a market-appropriate benchmark payment for common services that payers cannot exceed. In other states, reference pricing has been shown to reduce spending and can be an effective tool for slowing overall healthcare cost growth. Similarly, Massachusetts may also want to consider the use of upper payment limits for high-cost prescription drugs, an approach several other states have also begun to implement. The discussion here today about the proposed rate increases are a symptom of an affordability crisis that continues to grow in Massachusetts, which is further compounded by federal actions to cut access to coverage and undermine how we finance our healthcare system. At the end of the day, what matters most is the impact on individuals, families, and businesses across the Commonwealth who cannot continue to shoulder the burden of increasing premiums. Thank you for the opportunity to speak here today on behalf of consumers across Massachusetts. I'm happy to take any questions.
Thank you, Alex. No, I don't have questions per se. We appreciate your comments regarding the rate filings, and we will talk to our actuaries about looking more closely at the GLP and the admin level. So we appreciate your time. Thank you very much. Our next speaker is Liz Leahy, and Liz Leahy is the Senior Vice President of Advocacy and Engagement and Chief of Staff for the Mass Association of Health Plans. Liz, are you available?
I am. Can you hear me, Kevin?
We can now.
Thank you. Thank you, Deputy Commissioner Began, Commissioner Caljo. As Deputy Commissioner Began mentioned, I am Liz Leahy. I'm here on behalf of the Massachusetts Association of Health Plans. For those that are unfamiliar with MAP, we represent 13 health plans and one behavioral health organization that together provide coverage to nearly 3 million Massachusetts residents. including hundreds of thousands of individuals and small businesses covered through the merge market. I appreciate the opportunity to testify today and would like to use this as a chance to offer a 50,000-foot view of the landscape in which the rates proposed today are being offered. As I listen to the testimony today and review the public filings, I think there's one theme that really stands out. You know, whether the carrier is a national carrier or a local carrier, whether they are provider sponsored or independent, nonprofit, for-profit, regional, or statewide, their filings tell a consistent story. The underlying cost of healthcare continues to rise at a pace that's just unsustainable. It's unsustainable for consumers, for employers, for taxpayers, and for the healthcare system as a whole. Well, there are differences among the filings. You heard again and again the very same drivers: rising provider reimbursement demands, increasing hospital and physician costs, continued growth in pharmacy spending, and changes in member morbidity and the impact of risk adjustment transfers. I want to highlight that the consistency of these explanations matter because health plans are ultimately competitors. They compete aggressively with one another and each operate under different business models, but all are still operating and reporting on those similar cost pressures. I think you have to view this as really strong evidence that the primary drivers of premium growth are occurring outside of health plans themselves. I'd also flag that health plans in Massachusetts are subject to the most stringent financial oversight requirements in the country. Massachusetts health plans are the only participants in our state's healthcare system that are subject to comprehensive premium rate review of their rates. Medical loss ratio requirements are the highest in the country, limits on surplus that we've discussed today. Every premium dollar collected has to be accounted for. I'd also mention plans offer cost estimate tools for consumers to provide advanced information on the cost of care and to help members make informed decisions. No other sector of our healthcare system faces comparable scrutiny regarding the revenue it collects or the margins it retains. No other sector of the healthcare system provides insight into the cost of care. No other sector of the healthcare system seems to address the rising healthcare costs that we're facing, because the prices charged throughout the healthcare system continue to rise faster than wages, inflations, and what employers and families can afford. The reality here is straightforward. Premiums reflect the cost of care. I think there's also some growing concerns that you've heard throughout the testimony. Concerns about the long-term stability of the merged market risk pool, the impact of federal changes on marketplace subsidies and coverage affordability that are really threatening enrollment among the healthier individuals who help stabilize the risk pool. And at the same time, rising costs continue to place pressure on small employers, increasing the likelihood that some may self-insure, seek alternative coverage arrangements, or leave the market altogether, as you just heard in the public testimony from small businesses and employer groups. This creates a troubling cycle. Rising medical costs lead to higher premiums lead to enrollment losses and degradation of the risk pool. That risk pool deterioration then drives additional premium increases, and those premium increases impact an increasingly smaller group of individuals and small businesses. I'd also flag another important consideration as the division evaluates these filings. The proposed rates that are before you today reflect known and reasonably anticipated costs, but policymakers in Massachusetts continue to consider a number of legislative and regulatory proposals that will only further increase healthcare spending and premiums and are not reflected in many of these filings. These proposals include mandated reimbursement floors for federally qualified health centers, primary care, maternity care, hospital at home services, as well as proposals that would require coverage of higher cost branded prescription drugs when lower cost generic or biosimilar alternatives are available. There are also additional proposals that will further restrict tools health plans use to maintain costs and keep coverage affordable, including the coming implementation of limitations on prior authorization. While each proposal may be well-intentioned, collectively, they move us in the wrong direction. We're not addressing the underlying drivers of healthcare costs. Instead, we're asking employers, consumers, taxpayers, Mass Health, the Group Insurance Commission to absorb additional spending. Importantly, the affordability pressures that are reflected in these filings are the very same pressures that are creating budget challenges throughout the system. That underlying cost of care is impacting every purchaser of healthcare in Massachusetts. I think the filings before the division today should really serve as a warning call to all of us. Unless the Commonwealth begins to address the underlying drivers of healthcare spending, employers, consumers, taxpayers, Mass Health, the GIC will continue to face these escalating costs regardless of which carrier they choose. The rates being reviewed today are not the cause of our affordability challenges. They are a reflection of those challenges. We appreciate the division's careful review of these filings. We look forward to working with policymakers on solutions that address the root causes of healthcare cost growth. And we call on Massachusetts to preserve access to affordable coverage for our residents. Thank you for the chance to testify, Deputy Commissioner.
Thank you, Liz. That concludes the comments from those who had previously identified that they wanted to provide comments. Next, we can hear from members of the public who did not previously notify the division of their intent to comment, who are present today and wish to speak. If there are any members of the public that would like to actually have the opportunity to speak, we ask that you use the raise hand function, which is at the top of the screen. And then after that, we will identify those individuals and ask if they would like to speak. The first person is Eileen McEnany. If you don't mind introducing yourself to all, and then please proceed.
Thank you, Kevin. Good afternoon. I'm Eileen McEnany. I'm the president of the Employer Coalition on Health. We are a group of employers and employer organizations that have joined forces to amplify the voice of purchasers in the commercial insurance market, driven by our concern about affordability. And so I will offer written comments, but did want to just offer a couple of comments right now. And the first is, I did want to reiterate something that Chris Carlozzi had said. The comment about the value of health insurance has diminished greatly given the higher cost and kind of reduced benefits. It is an important one, and one that I would reiterate, because as we know, many small businesses are buying high deductible health plans as a way to stay in the game and be able to offer coverage at all. And I also wanted to reiterate what Alex Sheff had talked about. We do need to look at some kind of reference pricing. It can't just be runaway cost each and every year that those purchasing in the merge market are supposed to absorb. But I will say I listened really carefully to all the carriers, and it's interesting that their cost drivers are consistent across carriers, and they've been consistent across the years. And it's higher unit price and higher drug cost. The interesting thing to me is it seems like perhaps the emerging trend is the higher utilization and the more complex cases are. And to me, that's particularly discouraging because it means we're spending much more on healthcare, but we're not healthier as a population. And so I really would urge you to look into kind of, the complexity of the care, and particularly the specialty drugs. That seems to be another area where there's growing utilization. And the final thing I'll say is I know that the Division of Insurance has limited ability in what you can do with respect to these higher costs. But I would urge you to deliver the message of urgency to your sister agencies and to the Healthcare Affordability Working Group that the governor has convened, that we really do have to address these underlying cost drivers, or we're going to be here year after year simply talking about it. And so I thank you for the time. I look forward to submitting a written testimony. Thank you.
Thank you very much, Eileen. Are there other interested parties that would want to submit comments at this time? Please raise your hand. Wait a minute. Again, we're looking to hear from members of the public who did not previously submit their intent to comment, but who are present today and wish to speak. Is there anyone else who would like to? Seeing no further persons who are raising their hands at this time, this is our final call for speakers. I'll read my next text and then give you a chance to speak. We are accepting commentary that is sent in not only today, but also in written form. If any individual has been unable to attend the public information session or would like to submit information to clarify things presented today, we'd appreciate if written comments from all parties are sent through 5 p.m. on Friday, June 26th. All such comments should be forwarded to the attention of myself, Kevin Began, Deputy Commissioner at the Healthcare Access Bureau. And we will put this in the chat. My email address is kevin.began@mass.gov, and also to the attention of Rebecca Butler, Counselor to the Commissioner. And we will put this in the chat also at rebecca.butler@mass.gov. Our intention is to collect all such comments, and we have a website devoted to the 2027 merge market rate proceedings. We intend to take all written comments and make available on that website. Again, having read regarding written comments, I do ask one more time to see if there's anyone who has anything they want to say today. Okay, seeing one more time, there is no further information to be submitted. I thank everyone for coming today. If there are any questions about this public information session, please either contact Rebecca or myself. We will conclude the taped portion of this session. It's our intent to work to get this on our website within the next week. This concludes our 2026 for rates 2027 carrier public information session. Thank you very much for attending. I appreciate all comments and thoughts and would continue to welcome anything that's submitted in written form. Thank you. Hope you have a good rest of the day. Take care now. Goodbye.